Please.
All right, good morning to everyone. Welcome back to docket number 220808. We're here for the late file exhibit hearing in this matter. We will begin with any administrative matters before we turn to our agenda and panels of cross-examination. So does the company have any administrative matters this morning?
We do not, Chair Gillette, other than just having our witnesses adopt their late filed exhibits.
Very good, thank you. Are there other parties with administrative matters this morning? Attorney Wheel?
Thank you. Thank you, Chairman. The OCC filed a motion late yesterday regarding the availability of the availability of one witness and a request for adoption via affidavit of our other witness panel. I guess, with regard to Mr. Schultz and Mr. DeFever, we noticed on the agenda that they don't seem to be listed on the panel. So, as a matter of cost savings for avoiding the cost of them traveling from, Mr. DeFever traveling from Michigan, we were seeking permission for him to adopt their late files via affidavit. We also learned yesterday afternoon that Dr. Woolridge is ill right now. He informed us he was scheduled to get some tests and that he can't travel to Connecticut this week. So we noted that authority staff had reserved 10 minutes, I think, for Dr. Woolridge. And we're not really sure how to proceed. Dr. Woolridge did indicate he could participate remotely. We could file written responses to any questions that authority staff might have. We're not sure how else to resolve that issue.
Sure. Thank you, Attorney Wheel. And for the record, I think we're referring to motion 67, if that sounds right. We did have a chance to review the motion. I believe authority staff are prepared to waive their cross upon further reflection for Dr. Woolridge. So I think the question to the parties and interveners is twofold. And we'll start with Dr. Woolridge, noting that on page 10 of the agenda, only authority staff had reserved the right. So I just want to confirm that that means that no other party or intervener has crossed for Dr. Woolridge and thus would not object to adopting his late file exhibits.
For the company, Chair Gillette, the company does not object.
Okay, thank you. Any other party with an objection? All right, seeing none, Dr. Woolridge can adopt his late file exhibits by affidavit, please, and file by motion and affidavit, please. And the same question for OCC's remaining witnesses who, Attorney Will is correct, we do not have them listed on the agenda. Are there any objections to adopting those late file exhibits by affidavit?
No objection.
Okay, thank you. Any other party with an objection? All right, seeing none, then Attorney Wheel, it's fine if it comes in as, 67 had the affidavits.
They did not.
They did not. Okay.
We just didn't have time to get them signed and notarized before filing before this morning. So the 67 is framed as permission to later file affidavits, if that makes sense.
Very good. If you can then file the affidavits for the witnesses, and we will act on them in the record, and we will strike page 10 of the agenda from All right.
Thank you very
Anything
much.
further from the OCC this morning?
Nope, nothing further.
All
Thank
right.
you.
Thank you, sir. Attorney Marshall.
Thank you, Chairman. Deep would simply like to request a slight modification to the agenda. We would like to reserve the right to cross-examine UI's panel on the capital program plant additions and rate base and IT, if that is acceptable to the chairman.
All right. Very good. I'll add you to the end of page 3.
Thank you.
Thank you.
That's it.
Any other party or intervener with an administrative matter before we begin? All right. Seeing none, are there any members of the public that wish to provide comment this morning? Nope. Okay, then we will turn to our first panel on what are we at? Cost of service. So Attorney Vanora, Attorney Vaughn, if you could remind me, I believe all of these witnesses have been previously sworn.
That's correct.
Okay, if we can have these witnesses adopt their late filed materials, please.
Absolutely. Mr. Kolka, Mr. Therian, Mr. Ramal, and Mr. Eves. As part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of evidentiary hearings in this case?
I did.
Yes.
Yes.
And do you have any corrections to any of your late filed exhibit responses?
No.
I
No.
do not. And do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
I do.
I do.
Yes.
And Mr. Therian, have you also reviewed the response to late filed exhibit 13 filed by the company?
I have.
And for purpose of admission into the record, do you adopt that late file exhibit response?
I do.
Thank you. The witnesses are available for a cross-examination.
Thank you, Attorney Vaughn. We'll turn first to cross-examination by authority staff, and Mr. Skarzinski is up first, please.
Thank you, and good morning, Chairman Gillette and Commissioner Karen, and to the panel, good morning as well.
Morning.
If you could please refer to the response to late filed exhibit 4.
We have that.
Okay. First, can you briefly summarize what was modified from the original allocated cost of service study in the response to late file 4?
Just the R and RT classes were combined for the purpose of this late file exhibit.
And when you say combined, the costs associated with those were combined?
Yeah, the costs, the revenues.
Okay. And what were the results of the modification to the relative rate of return for the combined rates R and RT in comparison to the original ACOS results?
So the rate of return are provided in the attachment.
Yes, what were the relative, I'll rephrase my question. I would like you to state for the record in terms of the relative rate of return with the modification you made, comparing that to the original results from the relative rate of return for those rate classes from the original study.
Give me 1 second.
Sure.
So combine this 0.56, and then all you need to do is go back to your original application and tell them the R and RT were individually.
We're just pulling up the original study. Thank
Oh,
you.
that's fine. Thank you.
So the combined on the R and RT combined rate of return is 0.56, and the original study where there was segregated R was 0.32 and RT was 1.23.
Okay, I have a follow-up to that. On the original, for the rate R, you said it was 0.32?
Yes.
from the study filed with the application, I'm looking at exhibit E6.0 and I had a 0.27. Was there a modification to that?
Yes, as a part of OCC 379,
Okay, thank
we
you.
had to make a small correction.
Okay, very good. Thank you. Can you confirm that the modified output changes that were made in the response to LFE 4 were limited to only rates R and RT? In other words, just confirm yes or no, please, whether the other rate classes were modified in any way in terms of costs or no?
Sorry, I got confused. Yes or no to what
I'll
question?
restate it. I'm
Okay.
sorry. Can you confirm that the modification in the response to late filed 4 was only limited to rate class R and rate class RT?
Yes.
Okay. On page 1 of the response, not the attachment to the late filed, the company states that the modification would be more consistent with the rates panel hearing testimony that a combined rate R, rate RT, ACOS, allocated cost of service, would provide a more representative allocation of costs. What do you mean by the term a more representative allocation of costs?
So when we discussed this and formulated that response, we see very little, if any, cost to serve differences between R and RT. They're all residential customers. They all consume at a basic kind of domestic usage. They have very similar equipment, if not identical equipment, in order to serve them. So the only differential in the original study, which drove a lot of cost allocation differences, was the revenue from those two different classes.
Okay, and in the original study, am I correct in saying that from the original study that the company is stating that the cost causation is accurate from the original study?
Yes, it is.
Okay. Is UI sponsoring the use of the modified allocated cost of study results filed in late filed 4 instead of the cost of service results that were originally filed in the application? Yes or no is fine.
No.
Okay. Mr. Kulka, at the February hearings, you stated you were more comfortable with rates R and RT costs being combined into one rate schedule from the cost study to make the rate design based on the combined R and RT costs. Is that still your position today?
Yes.
Okay. One other item that came up was at the hearings, and correct me if I'm wrong, is I thought I heard that the company, when they did the original cost study, basically the clock ran out. You didn't have time to take a deep dive as to why the relative rate of return for rate class R was originally 0.27, but Mr. Remo, you clarified the update to 0.32, so we'll go with the 0.32. Had not done a deeper dive as to why that relative rate of return was lower than historically other cost studies provided by the company in prior rate cases. My question is, since the February hearings, has the company performed that deeper dive into the cost of service as a result of doing the late file 4?
We believe that the difference is due to the average use per customer between radar and RT, based on the amount of costs that are allocated on customer count. So costs that are allocated on customer count are essentially the same on a per customer basis. So the amount of costs allocated to R and RT per customer related to that are the same, but the average consumption of a rate R customer is about 1/2 of a rate RT customer. And so that difference between the average consumption is what's driving that difference between the two rate schedules.
Okay, just a follow-up to that is, so following that line of thought, therefore, the revenues associated with those two classes, those rate R and rate RT, there would be a disparity there based, to some extent, based on usage on a per customer basis. Maybe that's a better way to put it.
Yes. Yes, that if we were to try to recover the cost per customer based on a volumetric charge, then that volumetric charge is going to have to be higher for the lower use class. So if we want to capture $1 of customer allocated costs from rate R and $1 from rate RT, we have only 1/2 as many kilowatt hours to recover that from a rate R customer. So that portion of the rate necessarily has to be higher because the average cost per kWh is higher, and that's what we set the rate to.
Okay, thank you. Can you say with confidence that the combined rate R and RT ACOS model run or results is a better representation of causation and cost allocation than the original run?
I think they're both valid studies. And as we mentioned, there was very little difference between the two because the difference between the original study filed and that provided in late file 4 is simply combining the information from R and RT into a single class. So no information was changed. It was just simply combined for the first two columns into a single column. And as I said before, we believe that the cost causation to serve an R or an RT customer is very similar, if not very, very similar, which may indicate that the late file 4 runs a little better, but they're both valid.
Okay, thank you. That's all I have, panel. Thank you, and thank you, Chairman Gillette.
Thank you. We're going to turn to Director Ryer.
Thank you, Chairman. Good morning, panel. Good morning, commissioners. My name is Josh Ryer, authority staff. Actually, I want to start with a couple of follow-up questions on Mr. Skarzinski's cross. Actually, from a rate design perspective, can you remind me, there was a docket, I believe it was from 2005, that was referenced at the hearings that gave some direction on how to design rate RT. What was the?
There was docket 050604, and there were a couple of reopeners. So I think the rate design issues were in the supplemental decision.
Okay.
And then there was a little bit in reopener 2, and then a lot in reopener 4.
So my recollection of how that decision came up a couple of times was, again, in the context of designing RT, and also this discussion on a concern about migration from one rate to another. Would it be fair to say that that rate design direction may have implications for potential migration?
From 050604?
Or the relevant reopener, would that direction have implications for customer migration from rate R to RT or vice versa?
It did.
Okay. Could some of the migration concerns that were expressed in the previous hearing be addressed or counteracted by amending that direction, that rate design direction?
We are currently not seeing a lot of migration right now. So it's been fairly stable over the past few years. So I don't think that the current rate design is causing a lot of migration. There was a lot of migration up until 2017 when the restriction to be on rate RT if you were 2,000 kilowatt hours or older was rescinded. So that's what caused a lot of migration in those years, was that usage limit.
Okay, so so what is the underlying concern in this case then for a concern about migration if the current rate design is not resulting in any migration? So
If we were to use the radar and radar T cost of service study separately and implement that without any restriction on migration, we will embed right now the distribution difference between radar and radar T is about 1.5 cents per kilowatt hour. That could jump up to 7 cents per kilowatt hour, solely because of trying to recover the customer-related costs with a volumetric charge. It would go up by that much, which then would cause a very large difference between radar and radar T. That's not due to any time of use phenomena. It's due solely to that trying to recover customer charges over volumetric prices.
that's helpful. And so would the use of, and what life file was it again that you were just discussing would the use of that cost of service study that's updated mitigate that concern or rectify that concern?
Yes, I believe it eliminates it.
Perfect, thank you. Great, I want to turn to LFE 12, please.
Okay, yes, I'm there.
Perfect. You indicate that the cost of the low-income programs in New York are included in the overall revenue requirement. Can you just clarify for me whether that means that it's included in the distribution revenue requirement that's used to make up base distribution rates, or is it included in some other part of the overall revenue requirement?
It's in the distribution revenue requirement.
Okay. So is there an opportunity through that mechanism to reconcile what's included in base rates, base distribution rates, with the actual program costs?
I believe there is.
Okay, and is that done through the reconciling mechanism in New York?
I believe it's done through a deferral of the cost until the next general rate proceeding.
Okay, all right, so a reg asset. Okay, so can you walk me through how the New York PSC set the level of revenue for associated with the low income programs? Did they use some historical benchmark? How did they set that level for base rates?
I believe that the target for the entire state is 2% of revenues.
Okay.
And there's another docket that was specifically identified and adjudicated for the low income. And through that, and I'm just summarizing here, that the fixed discount, and it is fixed there, it's not a percentage discount, it is a fixed discount, that was developed through that larger docket and then brought into the distribution dockets of each of the utilities in New York. So
okay.
Those dollars were determined to be up to 2% of the entire revenue.
Okay, so do you know if it's 2% that's included in distribution rates, or do you know what the level is that's included in distribution rates associated with the low income programs?
I don't know the exact number, but it's I believe it's under 2% or close to it. That's the design, is to get close to it.
Okay, and I guess I made the assumption earlier that might not be correct that it'd be a reg asset, but I guess it could be a liability if it was set at 2% and cost her 1%. Is that how that mechanism would work?
I don't know exactly how they would do that, but I believe that's correct, that there's a reconciling account and the account gets reconciled in the next general rate case.
Gotcha. I guess I'm just clarifying the reconciliation can go both directions.
Yes, it can go either way.
And then I think my last question on this is, it wasn't clear to me, attachment 1, I don't see any references to low income programs. Can you explain to me how attachment 1 is relevant to the LFE question?
Attachment 1 in to show the rate design.
Is
So
there
you know that the low income is just a part of the overall revenue requirement. And that overall revenue requirement was allocated among their rate schedules according to what was in attachment 1.
are there any documents that explain how the low income programs were set and incorporated into the revenue requirement?
There's the entire rate case decision, which this is just an extraction of. So between that rate case decision and the low income docket, which is an extensive docket, but there is a decision for that too. You can piece the entire process together.
Okay. If possible, Chairman, it'd be great to get a supplement of just an extraction of the relevant portions of the rate case decision to the low income programs. Is that possible?
Okay, so Attorney Nora, Attorney Vaughn, can we supplement, what are we on, late file exhibit 12? We can,
Yes, we have all that data.
okay. Thank you.
So yes, that's no issue. We just need to know when we would need to file.
Very good. We'll take that up at the end here. I'll
Thank
make
you.
myself a note. Thank you.
And those are all my questions. Thank you so much.
Thank you. I believe that concludes authority staff cross, which brings us to the OCC's cross of this panel, please.
Morning. Tom Wheel for the Office of Consumer Counsel. The first question is about LFE 4 also. We couldn't, looking at LFE 4, we couldn't tell how the revised cost of service study estimated the non-coincident peak of the combined classes. Did you just add the two classes non-coincident peak together? Was that accounted for at all in this revision?
Yeah, we just added the two together.
Okay. And does the panel feel that's the appropriate way to treat the non-coincident peak issue?
I think for simplicity, we just combine them together. We didn't have time to run the load research again to calculate an NCP for our combined class.
Okay. So if there were other circumstances, like if you had run this scenario earlier and had more time to do it, would that have been something that would have been better to address differently?
Potentially.
Potentially?
Yes.
Thank you. I have some questions about LFE 7. And I guess they're really mostly about the contribution aid of construction standards. Just curious where curious how it works for the additional. It says here at Part D, the additional poles and wires must be paid for by the customer. Does that include the costs associated with installing those, or is that just the purchase cost of not purchase cost, the value of the poles and wires themselves? How does that work?
It would be installing them as well.
Okay. And how is that calculated? Is that like broken out on an hour basis as compared to the, like, how do you break out the installation costs?
Those will be developed using what we call compatible units. So for the installation of a pole, we have a design mechanism that would include the labor and material components of that.
Okay.
Estimated with a basic assumption around what the construction conditions would be. If there's rock, it may cost a little more in actuals, but that's based on historical averages.
Okay, thank you. I was also just a little confused about how the minimum annual payment is that. I guess my specific question is, where it says that it's derived from service at the applicable rates would be insufficient to warrant specific expenditures. So is that in addition to the contribution in aid of construction?
So that concept would be applied if we are making significant infrastructure investments based upon the promise of load, having a backstop mechanism if that load did not materialize.
So is it a separate concept from the SEAC altogether then? Like, does that apply even if there isn't a contribution in aid of construction?
It would apply in parallel with that, correct?
Okay.
For specific circumstances where significant infrastructure investments required to support a promised load, that may or may not materialize.
Okay, thank you. And then LFE 12, I had almost the exact same questions as Director Ryer. But a little bit of follow-up. I also noticed that the Appendix BB to that response doesn't specifically address the low-income discount rate anywhere. So just for clarification, the idea is that it's all the costs of that are in base rates, so the allocation is just in accordance with the general allocation of base rates there. Is that correct, Mr. Kolga? Okay. So the customers that are receiving the low-income discount rate are paying into the low-income discount rate just like all other customers in their rate class?
Correct.
Okay. And I was a little confused. I had the same question about whether there was a decoupling mechanism of some kind. And I thought I heard you say that there is one for the administrative costs, but is it also, I'll back up. The 2% goal, it sounds like the idea is when they built the revenue requirement in the applicable rate case in New York, the goal was to ensure that 2% of the entire revenue requirement was devoted towards the actual, not the administrative cost, but the discount itself. Is that right?
Correct.
Okay. So if there is an under collection, in other words, if the discounts are costlier than that 2% of the revenue requirement, is that subject to a mechanism to compensate for that in the next rate case? Is that what you said?
I believe that's the case.
Okay. And is that also true for the administrative costs? Are the administrative costs of the program part of that 2%, or are they just wound up in general, like the O&M costs inside base rates?
I don't know that for sure.
Okay. And just curious, in New York, do they have a similar regulatory structure where an electric company can stay out of a rate case more or less indefinitely, depending on things like settlements, like the situation here in Connecticut? Or is there do you know if there's a minimum, if there's a required rate case kind of timeline there?
I don't know if there's a required timeline.
Okay. Thank you. Those were all the OCC's questions for this panel.
Thank you, Attorney Wheel. Attorney Goodman with the CIEC, please.
Good morning, panel. My name is Jay Goodman, appearing on behalf of the Connecticut Industrial Energy Consumers. I have a few questions regarding late filed exhibits 4 and 5. But first, I'd like to ask a few foundational questions just to make sure that I'm clear on what those exhibits are showing. So for starters, with LFE 4, and when I refer to LFE 4, I'm actually referring to the supplement that the company provided with some additional information. Do you have that in front of you?
Yes.
Great. So if you look at the attachment that was provided with the original LFE 4, I'm sorry, the attachment to the supplement to LFE 4. Am I correct that in rows 4 to 9, what you're showing are the proposed delivery revenue increases that are allocated on the basis of delivery revenues only and subject to the tolerance bands shown in row 5. Is that correct?
That's correct.
Great. If you look to rows 10 to 21 in the same spreadsheet, that's showing the total of delivery and other revenues that have been increased each rate year per the company's proposals, correct?
Yes, through line 21, noted on the spreadsheet. That's correct. 3 years.
Great. And I think the next two are pretty clear, but just to be fair, I'll ask. The next section that's labeled results, that's showing the relative rates of return that would result each rate year if the proposed delivery revenue increases allocated on the basis of delivery revenues are as shown in the first part, correct?
Yes, it's a rate of return ratio. That's correct.
Great. And that's a straightforward, that's simple math, right?
Yes,
Straightforward to do. Great. And the last section just shows the annual delivery revenue increases by service class and rate year.
That's correct.
Now, if you could turn to LFE 5, specifically the table provided in the attachment. The answer state, your LFE 5 answer states that the class rates of return and relative rates of return using the proposed equal bundled rate percent change method are shown in the attachment. The attachment has a table with heading equivalent test year 2021 class absolute and relative rates of return using the proposed equal bundled rate percent change method. Could you explain what the table is actually showing? Or I can be more specific, I apologize. What I'd like to know is it showing the relative rates of return for the test year revenues at current rates, or is it showing something different?
It is showing test year at current rates.
Using the bundled methodology, correct?
Using the bundled methodology, correct?
So if we wanted to compare the relative rates of return that would result using the delivery-only allocation method versus the bundled method, it would be a fair comparison to look at LFE 5, the table provided in LFE 5, with the test year rates of return, relative rates of return shown in the LFE 4 supplement. Is that correct? Or the attachment to it?
May I confer for a second, please?
Sure.
So
Rates of return are based on the delivery system. They're not based on generation, right? Gross return. We changed the distribution rates. It's based on the bundled bill. All of these are based on distribution only.
I just wanted to verify my next statement, which is this is a rate of return, relative rate of return, and the rates of return are based solely on the distribution. Distribution in this case, there's no like generation rate base that the company has. So there's a difference between comparing relative rates of return versus how a proposed rate increase across the classes may be.
But do the resulting relative rates of return change based on the allocation method that you use?
Yes. Between if you were to allocate the rate increase based on a percentage of bundled revenues versus distribution only revenues, you would get a different answer.
Okay, so if you look at LFE for attachment, I'm looking at, I believe, row 42. It's showing the relative rate of return. I'm sorry, row 43 is showing the relative rate of return revenues at test year for the large power time of day or LPT service class. And that's indicating that using the distribution only allocation methodology, current rates test year, correct? You get an RROR of 2.87.
I'm sorry, sir. Can you slow down? I think you
Sorry.
lost me on line 42.
Sure. I misspoke. It's line 43. Revenues at test year.
Are we talking Excel line or exhibit line?
43 in column A when you wrote.
Oh, I'm sorry. I had the spreadsheet over a little bit. It was masking the row numbers. I apologize for the confusion. I'm looking at in the spreadsheet what the company labeled as row 22 revenues at test year. And I was looking at the rate LPT class.
Which attachment?
No, it's okay. I got it.
It's attachment 1.
To the supplement. Okay. We're jumping between attachments as needed, and
Yeah,
we got a little lost. I apologize. I believe we're with you now. We're on labeled line 22, late file 4 supplement, attachment 1, where it says revenues at TY, which is test year.
Correct.
Okay. Yes, I'm there. Thank you.
Okay. And if you move over to the LPT, rate LPT column, it shows that the relative rate of return is 2.87, correct?
Yes.
So then if you turn to the LFE 5 attachment, which shows a comparable number for the relative rate of return test year revenues, but using a different allocation methodology, the relative rate of return for the LPT class increases to 3.51, correct?
That's correct.
And if the relative rate of return is increasing from 2.87 to 3.51, isn't that moving away from the cost of service instead of towards the cost of service?
It's there are two different methodologies in order to achieve the same approach. So one methodology says, let's use bundled revenues in which to allocate the proposed increase, and the other says, in late file 4, attachment, supplemental attachment says, let's use the distribution revenues, which is consistent with guidance in previous proceedings.
Right, they're different allocation methodologies, but depending on how you allocate the revenues, you agreed a few minutes ago that it can affect what the resulting relative rate of return is.
Yes, I agree. That's correct.
And I believe there were several comments during the earlier hearing that the gold standard, if you will, is moving towards unity, right? Towards 1.0, cost of service. Would you agree?
That is what we said previously, and I'll stand by that, yes.
And you'd agree that here, when you change the allocation methodology from delivery only to bundled, you're moving the opposite direction away from 1.0, correct?
So that's what the results say. However, there's many different ways to allocate revenues to achieve the gold standard of 1.0. And based on my recollection of what Mr. Kolka testified to during the general hearings, the reason why the bundled methodology was chosen was based on the company's overall belief that customers pay a total bill. So that was the principle behind the methodology selection. So in cost allocation or rate design, there are a lot of different considerations, okay? And yes, this gold standard of achieving a 1.0 rate of return is certainly something that I look for, but it has to be supported by fundamentally strong assumptions. And I think if you are going to employ an across-the-board increase and the company believes that the most appropriate methodology is based on bundled revenues, I think that that's a fair assumption to use.
So regarding the principle you just mentioned, I'd like to put a pin in that and come back to a follow-up question in a minute. But in terms of the choice of allocation methodology, if what these data show is that if in the test year you had chosen the bundled allocation methodology as opposed to the delivery only allocation methodology, you would be taking service classes, LPT, GST also have similar movement, and moving those relative rate of returns as between the two allocation methodologies further away from their cost of service. In other words, increasing their relative rates of return and increasing the extent to which they may be subsidizing other rate classes.
Based on that one particular rate design consideration, yes, I would agree with that. That's clearly what the results say.
But can you tell me, LFE 4 shows, using the delivery only allocation methodology, the relative rates of return for each rate class in each rate year under the company's proposed revenue increases. Is there comparable data? I don't recall if there's somewhere in the record where the company provided similar information using the bundled allocation methodology. In other words, under the proposed revenue increases for each rate year and rate class, have you provided what the estimated relative rate of return for each class would be?
Two-part answer, if I may. First, just for clarification, late file 4 attachment isn't a proposal. It's a calculation based on the methodology from a previous UI docket or two previous UI dockets, and we are asked to provide a calculation. So it's a benchmarking analysis, I guess you could say. The original proposal from the company is what it is, okay, and that's included in the application. The second part of your question about whether we provided 3 years worth of relative rates of return, we did not. We provided year 1.
Given that that's a very straightforward calculation in simple math, would it be possible for the company to supplement, even as a read-in perhaps later in the day? Because I think it would not take long to do the calculation.
Read-in. If I may, we could do a read-in.
If we could, yeah, if it turns out to be straightforward, we'd have no objection to providing it as a read-in.
Okay.
Thank you, Attorney Benoit.
I am gonna call that read-in 1. Okay, thank you. I have no idea what letters we were at, so I'll just go with read-in 1. Thank you.
I don't know what letter we're at either, so one sounds good to me.
Okay, thank you.
One or two more questions regarding the bundle allocation methodology. What revenues, in addition to delivery revenues, are included in the bundle? It's everything, correct?
I'm sorry, please repeat that.
Sorry, I shouldn't ask. Just for clarity, rather than resting on what I think the answer is, if you could just state what, when you refer to the bundle allocation methodology, what are the revenues you're bundling other than delivery?
All the components, generation and all the delivery, public policy components.
Would you agree, though, that in this case, we're only considering the delivery revenues, correct?
Distribution.
Sorry, distribution.
Yes.
Okay. Excuse me 1 minute, just want to look through my notes, see where I am. So if we could go back to the principle that you just referred to, Mr. Therian, I believe you said that I'm paraphrasing, please tell me if this isn't a fair summary, that the company chose the bundle allocation methodology for the rate years in this case on the principle that the customer looks at the whole bill. So therefore we use the revenues that are reflected in the whole bill for the allocation. Is that correct?
I'm only looking at Mr. Kolka because that was my recollection of his testimony during the hearings. That was
No, our proposal was to defer the detail rate design to another docket. That docket is not available. That was our proposal. And we use this as a temporary proposal. So we no longer have that docket, but this is still our proposal.
To use the bundled revenue allocation methodology, correct?
Correct.
But for the principle that Mr. Therian had referred to, did I summarize it fairly, or would you state it differently?
Our bundled proposal does not move us closer toward equal rates of return. That was, our proposal was to do that in a different docket.
Okay. But you also stated that you chose the bundle allocation methodology because you think the customer looks at the whole bill, and so you're allocating essentially on the basis of the revenues reflected in the whole bill, correct?
Correct, yes.
So if the allocation were to be done on the basis of delivery revenues only, just for the sake of discussion, and in rate year one, the customer gets the bill reflecting a delivery only allocation of the increased revenues, would you agree that the customer would see that increase looking at the whole bill?
Distribution increase. They will see their bill. We don't know exactly how they're going to dissect it, but they will pay the entire bill regardless of how anything is determined.
Right, and so they're not going to dissect it regardless of which allocation methodology is used, but regardless of the allocation methodology that's used, they're going to see a bill increase.
Correct.
So given that, why should your opinion of how customers view their bills justify which allocation methodology should be selected?
Once again, that was our original proposal, was to defer the rate design to a different docket. So that is no longer available.
I understand, but you're still recommending a bundled allocation methodology, correct?
Well, we've provided late file 4 to provide the authority with sufficient evidence to determine which allocation it will be preferred.
I understand, but you've also said that late filed 4 does not reflect what your proposal is, correct?
It's not a formal proposal. It's put there as additional evidence for the authority to consider when they make the decision.
I understand. I do not think you have answered my question, but I think that the answers are close enough to make the point. I have one or two more questions. In the earlier hearing, there were several references to Bonbright's book, and I believe the witnesses in various points in discussing it have recognized Bonbright as kind of an authoritative reference for rate making. Is that correct?
Yes.
Can you tell me where in Bonbright's book it's recommended that revenue requirements should be allocated to the different rate classes according to how customers view or pay their bills?
I can't do that today. No, I don't have the book in front of me.
I have it in my bag if that would help. But do you recall any mention in the book of an allocation based on that principle?
I don't recall.
Do you, Mr. Kolka?
I don't recall.
Mr. Reimal, you're familiar with Bonbright too. No recollection?
No.
I have nothing further. Thank you.
Right. Thank you, Attorney Goodman. Attorney Bidrup, please. Thank you. I believe that reaches the end of our agenda for this panel. Attorney Venora, a moment to consider redirect.
Yes, please, if we could have 5 minutes.
Okay, we will recess for 5 minutes.
Yeah. Oh. Let's see. Okay, perfect. We did
Yeah.
Okay, Attorney Venor?
Yes, we have no redirect for this panel.
Okay, then thank you to the panel. Let's see. The read-in, maybe we can check after lunch or,
Yes, we'll do that either on a break or right after lunch.
okay, well then, subject to that information, the panel is excused. Thank you.
Thank you.
Thank you.
All right, we will move into the company's panel on the capital program plan additions, rate base, and IT. So we can summon up the company's witnesses for that panel. Authority staff will begin cross. Attorney Vaughn, Attorney Venora, if you could, looks like your witnesses may have all been sworn in.
Yes, yeah, this panel has all been sworn.
Okay, very good. Then once the witnesses get situated, if we can adopt pre-filed materials, please. Okay.
Believe everyone's settled enough for the panel. Before we have the witnesses adopt their materials, Mr. Donnelly, do you have a correction to your title? That could you please state your title for the record?
Sure. Just to clarify, Senior Vice President of Planning and Regulatory for Avangrid Networks here on behalf of UI.
Thank you, Mr. Donnelly.
Thank you.
All the witnesses, as we mentioned, previously sworn in. So Mr. Hurwitz, Ms. Wakefield, Mr. Dane, Mr. O'Laughlin, Mr. Layton, Ms. TheBerge, Mr. Donnelly, Mr. Mullen, and Mr. Hulk. As part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of evidentiary hearings in this case?
Yes.
And do you have any corrections to any of your late filed exhibit responses?
No.
And do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
Yes.
Thank you. The panel is available for cross-examination.
Thank you. We'll begin cross with authority staff. Mr. Paff.
Good morning, everyone. Having a little technical difficulties. I was anticipating using commanding the mouse and keyboard from here, but it's being a little jumpy. So I'm sure we'll make it work. But I have one line of cross for you all, and it is focused around the updated plant model that you provided in LFE-1 attachment 2. And my first question is, can you describe the plant model? And you can describe it first at a high level, and then if as part of your description, you can talk about how the plant model was developed, how it's utilized by UI, what information specifically it's being relied upon for purposes of inputs to the rate filing, and then how the information is reviewed and validated so that you know that it's correct.
I'll start and then ask my co-panelists to weigh in. The plant model, as we've called it, provided in this proceeding as at first OCC 84 UI attachment 13, and now an updated version is LFE1 attachment 2, as you've noted, is the work paper we've developed to compute rate base in the rate years. And so that involves a variety of components. First is plant. We begin with the test year balance of plant broken down into, I'll term it, functional categories: distribution plant, general plant, and intangible plant. And we run through the plant model the projected amount of the plant additions over the next few years to arrive at an amount of gross plant. And from there, we compute things like depreciation expense, which then flows through to accumulated depreciation, deferred income taxes, which then flow through our computation of current income taxes in the revenue requirement, and accumulated deferred income taxes. The output of the plant model affects a handful of schedules throughout the revenue requirement, primarily the B schedules, which relate to rate base, and then also certain components of our computation of current income taxes. You asked for a description of a lot of things. I'm not 100% sure I touched on all of them, but I might see if any of my co-panelists have anything to add.
That captures it. Just to recap at a high level, the plant model is intended to calculate the plant-related elements of the revenue requirement. So as Mr. Hurwitz said, plant depreciation and income tax impacts.
Okay, I think that covered the initial, or one of the initial questions that I had, which was essentially a high-level overview of what the plant model actually was. How was it developed?
It was developed with the intent of calculating those outputs. So starting with inputs such as the plant forecast. There's also capital forecast components that affect income taxes. And then rolling those through calculations related to rate base, so gross plant, net plant, deferred taxes, and then also calculating depreciation. So plugging in Mr. Kennedy and Ms. Norrie's depreciation rates, and then calculating the income tax impacts that flow through the revenue requirement.
And is this a model that was created specifically for this proceeding, or is this a model that's been used in past proceedings?
I'd say it's a mix. So there were examples to pull from past proceedings, but this was modified to make sure it was appropriate for the inputs and outputs of this proceeding.
And was it developed internally by the company or by consultants, or a mixture of the two?
My firm, Concentric, took the lead and then worked collaboratively with the company to refine and make sure we were reflecting the appropriate assumptions and outputs.
And was there a specific process that was used to review and validate the results of the model? Especially because it sounds like it wasn't a situation where there was a model that had been reviewed previously, and in the current case, it was just a matter of updating the inputs. It sounds like some of this was created for this proceeding specifically.
I would put it this way: for filing, we wanted to ensure that the plant model reflected this case's specific inputs and outputs, Connecticut specific considerations related to income taxes and the like. And so, to your question, yes, it wasn't simply a matter of plugging in inputs to an existing model.
Okay, and I guess that maybe partially answers my question, but the other part of my question was how it was reviewed and validated, the results.
Sure, I'll start at a high level. It's an iterative process. The revenue requirements developed over a number of months, and so putting together the model, checking that it works at a high level, then flowing through inputs, working with the company and its subject matter experts to understand the reasonableness of the inputs and the outputs through an iterative process over that time.
And is this a model? I know that you said that it was a model that was a result of some combination of consultant and company input. Is this plant model used by the Concentric? Is that your firm's name?
Yes, Concentric Energy Advisors.
Okay. Is this a model that is used by Concentric or some portion of the model used by Concentric in other proceedings, or is this something that Concentric just developed for UI specifically? Does that make sense?
Sure. And we're calling it a model. I might describe it as a spreadsheet with a variety of calculations in it. And certainly the calculations aren't unique to this proceeding in terms of rate base is a fairly standardized calculation, and depreciation, both for book and tax purposes. Again, there are certain fundamental calculations that are involved in developing those. And so this quote unquote model, again, is a series of spreadsheets that incorporate those types of analyses that we certainly would have done in other cases and the company would have produced in other cases. The model, which is the summation of all those calculations, in this instance is unique to this case. But again, those calculations can be found throughout other rate cases, both at the company and throughout industry.
Okay, so to the extent that calculations within the quote unquote plant model represented fundamental rate making calculations, that's something that probably would have been leveraged from other past proceedings.
I would probably lean more on accounting calculations, so depreciation, applying depreciation rates to plant balances. That's an accounting concept that's reflected in the calculations. Gross plant, net plant, again, those are accounting concepts. So I don't know that it's necessarily deriving those from other rate making proceedings, as you said. It's just the application of those calculations and principles in this plant model.
Okay. Well, part of the reason for my question is I'm trying to understand whether this, how much of this model was newly developed for this case and how much of it has been vetted in other cases potentially, if that makes sense. Just because, I mean, obviously, working with numbers and spreadsheets as much as I do, I'm sure that each new entry and each new formula is a potential for something to be misfigured or referenced to the wrong area, et cetera, et cetera. That's part of the reason for my question, is to understand how much of this is something that has been reviewed and vetted in the past, and how much of it hasn't. It sounds like it's not really possible to specify specific areas because it's too much of a mix between what has been used previously and what was created uniquely for this proceeding. Would that be accurate?
Well, just to address something in your question, it was reviewed and vetted for this case. And the company, I can let Mr. Hurwitz speak to where the company may have used similar models or calculations in other cases. But to be clear, this calculation and model were put together and vetted throughout this case to make sure that it appropriately reflected the inputs and outputs that we wanted it to.
I would add, as Mr. Dane just alluded to, the company uses a model that is conceptually very similar to this, and the company's affiliates in New York and Maine use a model that's conceptually very similar to this for many of the foundational concepts you'd expect in a plant model, like depreciation and retirements. But the rules tax-wise for what flows through and what's normalized differs by state. So there are Connecticut-specific elements of that you wouldn't expect to see in other plant models because of those tax rule differences.
And Mr. Paff, maybe just to go further, I wouldn't describe this as a bespoke model specifically for this case. Again, what I'm describing is that the calculations are fairly standardized. This particular iteration would be unique for this case just because it's different inputs and we have to reflect the well-established SFRs in Connecticut. And so those are the elements that I'm describing in terms of the uniqueness of this iteration. But again, that the calculations are what I would describe as fairly standardized.
Okay. And Mr. Hurwitz, I know that you said that some of UI's affiliates use a model that is conceptually very similar. Is that what you said? Did the company attempt to use that model as a validation check, whatever model is used internally, for the items that wouldn't be unique to Connecticut?
As Mr. Dane described, we took a variety of steps to validate the output of this work paper, but that was not one of them.
Okay. Okay. Now I'd like to move to the spreadsheet itself, and I will try to make this a little bit bigger. Okay, sorry about that. Okay. So as I was going through the spreadsheet, one thing I noticed is that there's several items that are marked as, or that have this blue fill color. And, oh, go ahead. If yes, oh, okay. And what I imagine that was is that those were the figures that were being hard coded and then used to, then when those figures were input, then the model would update and the rest of it was formula driven. Maybe an incorrect assertion, but go ahead.
More generally, the blue highlighting was intended to denote changes in both the revenue requirement and the plant model, and to make it easier for users to identify where changes had occurred.
Okay. And when you say changes, do you mean changes from the original filing?
Yes. And to your question also, if there were links between models, it can be messy to try to transfer those with links intact. So the link between them would have been broken. And I'm not recalling perfectly if we highlighted those, but the blue highlighting would generally be intended to reflect those interlinkages as well.
Okay. And just so again, I understand what the blue highlighting was meant to represent. Was the blue highlighting meant to represent the items that were updated from what was used in the original application filing?
Yes, and we produced these spreadsheets in OCC 84, I believe, as well. So which reflected what was in the initial filing, and so updates to the filing, which was also produced in OCC 84.
And what I would like to do now is go through the items that are highlighted and have you all, if you could, direct me to where in your, wherein I assume there would probably be an LFE 1, but where I can tie back these figures to other areas of your application.
Sure. And we'll try our best. There may be some that we want to confer or check on a break, but
okay.
Yes.
So the first one here is this electric distribution line item, and I've labeled all of these. So hopefully this will be quick, but
The change to these values relative to OCC 84 attachment 13 should be linked to the company's supplemental response to CAE 12, which describes some modest reductions to the projected capital investments associated with the company's medium and heavy light duty make-ready light duty vehicle program. That response will not provide the numbers that are highlighted in blue here, but it will provide a change relative to what was initially requested for those amounts. So the difference between these numbers and what was reflected in the original OCC 84 attachment 13 should be from that response.
okay. And it was CAE 12.
That's my recollection. Give me one moment and
Okay.
I'll confirm that for you.
I can confirm that. I can confirm that.
Okay.
And it, Mr. Paff, it affects both this section that you have up on the screen, capital expenditures, as well as the section below, which is plant and service.
Okay, great. That's my next question. And the original amounts, would they be on a B schedule? So the original amounts that I would use CAE 12 as the change, and then the original amounts, I assume, are on a B schedule. Is that accurate?
This will flow through to a B schedule, but when I said the original amounts, I was referring to the amounts reflected in OCC 84 UI attachment 13.
Mm-hmm.
And those, subject to check, are supported by one of the first tables in Mr. Eves' testimony.
Okay. So there isn't a separate location on the B schedules where the original amounts would have been included.
Not these specifically. These are
Okay.
calendar year amounts, which don't
Oh,
align
okay.
with the rate years. So one of the reasons for developing this work paper was to bridge that gap.
And this tab in the spreadsheet, these are inputs to the plant model, and the outputs are the B schedules.
Mm-hmm.
So as Mr. Hurwitz said, these numbers will travel through this spreadsheet in the plant model to calculate the outputs for the B schedule. But this particular page is plant additions. And so you won't find these specific numbers in a B schedule. They will be reflected within plant in the B schedules in the revenue requirement.
Okay. This is the next change that was marked.
Give me one moment.
Okay.
Sorry, could you just repeat your question, or if there was one?
My question was just how I can tie back either this number specifically or the change in this number from the previous iteration of the plant model.
This one would be from LFE 23.
LFE 23, okay. And what was LFE 23?
That describe. I might ask my colleague.
Okay.
That was the correction that Mr. Eves noted at the beginning of this original testimony. I think it was RSR 3 or RSR 8, where we had identified some capital expenditures that were more akin to SCADA for transmission, and we were making adjustments. So what we did was look to see when those capital expenditures were placed into service, and we identified this $2 million amount having gone into service either in 2022 or 2023. So we made that adjustment, reducing this in the base level of re-ear additions.
Can you describe what led to that correction?
So as we were reviewing documentation related to, sort of individual projects that were in those other schedules, we had several meetings to discuss the nature of those investments, and also as part of evaluating this year's capital expenditure and the ongoing process. I think Mr. O'Laughlin kind of described how that works. We met with the folks responsible for those programs and determined that they were more aligned to SCADA. This was the corporate security initiative. So having made that determination for the 2023 expenditures, we went back in time to look at what else we had placed into service since that project began and identified these amounts as needing to be reclassified to transmission 353 substation equipment.
And is that something that is that a review that generally happens after the rate filing, or would that be a review that would be performed before a rate filing to make certain that there were no transmission related elements in a distribution filing?
Right. I would say it's ongoing iterative reviews. I mean, I think what initially brought this to the table was the 2023 capital expenditures, and looking at that program for cybersecurity, which I think we talked a little bit about. That type of technology isn't necessarily overtly discussed in the FERC Uniform System of Accounts, since it's written in the 1960s, and these are new technologies and assets that are being installed. So when we recognize that type of investment was now moving into more of the SCADA, so away from the original backbone of the network, I think is the way that you had phrased it, Mr. Eves. We, of course, wanted to go back and make sure that we hadn't missed anything that we had included in the base level of capital expenditures, and we found those, or identified those projects as part of that process.
And you said it's an iterative process, right?
Right. So this cybersecurity project has been ongoing for several years, different phases of that project. Initially, forgive me because I'm only an accountant, but building the backbone of the communication system and then going from there. I don't know if Mr. Eves or Mr. Donnelly want to add.
I mean, as we move into distribution automation and begin to couple the systems that protect the transmission system with work we need to do on the distribution system, we are evolving into this area where the security systems bridge both sides. So I think in our review, we determined that these specific security investments should have been classified as transmission, and I think that's an ongoing development as we continue to secure and digitize the distribution side. We're going to be continuously evolving our analysis on how to accurately classify those investments between the two.
And how does the company feel comfortable that there aren't other elements and other projects that are that would be more appropriate to direct to transmission if the company reviewed them? But I'm not sure if I'm phrasing my question I'll try one more time. If the company doesn't perform a comprehensive review of all of its projects before it makes a rate filing to ensure that the components that it's seeking recovery of are specific to distribution, how can it feel comfortable that this one item that it corrected is the only item that that would be applicable to transmission.
The majority of the investment is directly on assets, which we know are transmission or distribution, so overhead lines, substations, et cetera. Where it's sometimes a little more gray is in general property and intangibles, where you have to do a little more of an evaluation as to what the underlying purpose of those assets are for. So we have some documentation. We have a 7-factor test that we look at, and those are generally the areas that would require additional review, and those are the areas that we did review in the schedules prepared for this filing. Once we found the security item, we did look at, you know, all of the sort of general property investment. The other thing is general property is allocated with the wage allocator between transmission and distribution. So oftentimes it's recognized that those type of investments are supporting both lines of the business. And, you know, with some exceptions, which I believe the only exception for UI is the investment that transferred from UIL to UI being treated with the Massachusetts formula. Everything else in general and intangible follows the wage allocator. So in this particular case with security equipment, initially the business was thinking it's general and intangible because of the nature of what it is. It's hardware, IT type systems. And so when looking at the 7-factor test, and actually what we're trying to accomplish with that investment is protecting the substations from a SCADA perspective. So I would say that the company is aware of some areas which are a little more challenging for the business to apply a transmission or distribution allocation. And those are the areas that we spent more time reviewing to get comfortable that we had looked at everything which might fall into this same scenario. And you know, something that we'll take moving forward when we're reviewing, you know, the iterative process of new investment. So.
Yeah, and if I could add a little bit more to that response as well. And you've heard from Mr. Berg doing an excellent job just describing the overall approach to how we want to make sure we get it right at the end of the day. And we do our very best before we file a rate case to do just that. And so I just want to restate, I think perhaps I heard you, maybe it was unintentional, suggest that we didn't necessarily do a thorough review. So I just do want to clarify for the record that the company spent many hours going through and scrubbing, particularly what we are going to bring forth to, one, make sure it was needed and appropriate, and we had full justification and documentation to support the capital needs as we best see fit to best serve our customers to provide that safe and reliable service. As we continue to go through, if we find something through preparation, through an interrogatory response, through a late file response here today, we're going to want to get it right. And as we also have our ongoing budget process just within our own company, outside of a rate case, as things evolve and new information comes to light, we're going to look at where are those projects, the benefit of them, the need for them, what is driving ultimately the benefit from them. In this case, you've heard descriptions of some additional cybersecurity related programs and projects that really, as they continue to kind of stack and evolve on top of each other, because they build in terms of the need and the benefit, became apparent that those were more transmission related and transmission driven. With that new information, that was the determination to say that's why they're not in the forecast going forward. Let's make sure and evaluate any underlying projects that may have been undertaken that helped get that program to this point. And with that, there was identification that there were a handful of previous projects that had been undertaken that really now serve a larger transmission benefit and need. So the company identified those, flagged them, made the appropriate adjustments. This is what you see here. It's what Mr. Eves opened with during the first days of the hearings when we first talked about capital with the panel.
And Miss DeBerge, is that how you pronounce it? You mentioned this 7-factor test. Was the 7-factor test for the project or projects that comprise the amount that was originally attributed to distribution that the company now believes should have been attributed to transmission? What was that test performed before the rate filing, or it was performed during the rate filing?
So to clarify, the 7-factor test is sort of a standing documentation that we have on evaluating, I believe it's mostly substations between transmission and distribution. So it's not a test that is applied to each portion, like each investment project. It's a guidance document that we use. It's several years, it predates me, I do believe, because conceptually, you know, that hasn't really changed when you're looking at substation equipment. And in this case, as we were talking about security, you know, sort of stacking and evolving, we were talking about earlier in the hearing, you know, the backbone of this cybersecurity system, which has many future benefits to distribution automation. So what we analyzed here was just when we moved in this one project from the backbone that benefits both businesses to more transmission scope of work that is really just supporting transmission substations. So initially in the filing, this was in general property, which is allocated with the wage allocator. The wage allocator weights more heavily to distribution, which is what led us to look at, does that weighting, does that allocation align with what we're saying in our 7-factor test documentation, in which case we determined, no, this should actually be more, you know, transmission, 100% transmission, rather than the wage allocator, which is, I think, between 15 and 20% transmission. So
I think the challenge here, as Ms. DeBerge laid out, is the application of it to specific electrical infrastructure, as opposed to the application of it to cybersecurity assets that are really protecting, you know, have a role in protecting both, and how you evaluate that cybersecurity investment regarding the test, you know, to establish whether it's transmission or distribution. So that's the electric infrastructure we've been doing for 100 years. The cybersecurity is a new evolution that we're working through.
And I'm not sure you stated this directly, but sorry. I'm not sure if you stated this directly, but is there a particular enhanced review process for the cybersecurity items?
So currently what we've asked the cybersecurity team is to document in more detail the different portions of the project. What exactly are you doing? You know, are you putting a hardware cabinet in a substation to support communications to the data center, for example? So my colleague, Mr. O'Laughlin, and I have been meeting with those project managers in the business and seeking additional documentation as a result of sort of this initial analysis that arose right before the hearings, so that moving forward, we have additional documentation from that team so we can better apply the 7-factor test and the, you know, FERC Uniform System of Accounts and the guidance that we have regarding how investment should be treated. Yes.
Okay. I think I just have one or two remaining questions about this, but in terms of how the correction was actually identified, was that, or when the error was identified, was that through the 7-factor test, or was that through another process?
I might need to bring Mr. O'Laughlin up, but it began with looking at the 2023 expenditures and meeting with those project managers and seeking more information for 2023, in which case we began looking at the nature of what are they doing now and how does that correspond to what we have in the 7-factor test, like what actual physical assets are they installing, where within the grid, et cetera. So it actually, the conversation began before the hearings. And then as we were concluding in the forecast that these items were transmission is when we circled back to say, okay, what have we done since the origination of this project in the last, 3-4 years? And how are those investments categorized? And do we need to make a correction to where they reside within the FERC uniform system of accounts, the way that we carry our plant? So we would have made that adjustment anyway, but we also needed to reflect it because of the timing, in these different schedules. So it started in the normal course of the business process in the annual review. I don't know. Yeah. Maybe.
So when we review the capital plan, we do an annual review looking at the 10-year plan and establishing the following year's budget. So at that time, we do conduct a review of all the various projects that are included with the plan. Additionally, as I mentioned at the prior hearing, we have our investment planning process that has those 5 different stage gates that projects individually move through. So as part of both of those reviews, we look at the classification of projects and the investment in terms of whether they are transmission or distribution. There are classification guides, asset classification guides that the project teams use in terms of determining whether assets would be transmission or distribution. Typically, that would apply to something like a substation project where you would have a mix of transmission and distribution assets that we need to ensure that we're separating into the appropriate classifications and separating them in terms of projects. So there's really 2 passes that a project would go through where we have an opportunity to check for the proper classification. Right? So it's at the plan level. We do that annually. We review all the projects in the plan, as I mentioned. That's the process in establishing the plan for the 2023, so 22 effort for establishing the 23 plan, where we looked at the projects and identified that there were some classified as common, which would be projects that split between transmission and distribution based on the wage allocator. And we dug deeper to see if there were assets that could be directly allocated to transmission or distribution based on the nature of their function.
Okay. Thank you for that. We'll move on to this next series of updates.
Is there a question?
The question is where I can find either this specific amount or the change from this amount to OCC 84.
Sure. These would be from LFE 23.
Oh, okay.
Mr. Pfaff, do you mind if I just state for the record, because I don't think it'll show up in the transcript, what you're looking at right now? But I
Sure.
believe you're looking at the net plant tab on LFE 1 attachment 2. The rows designated in the 13 through 15 column H. Is that correct?
I believe that's correct. I just want to check your column numbers.
Yeah.
Yes.
Okay, thank you.
And I can further clarify that these are the test year end gross plant balances. The only change from the filing and OCC 84 was those identified in LFE 23, which were the updates that Ms. TheBurge and Mr. Eves were just describing.
Okay. There are two more of these categories, so bear with me.
This is the depreciation reserve as of the end of the test year. This is highlighted in blue because it's a link to another spreadsheet. There was no change to this item. We reduced gross plant for the updates that Ms. TheBurge and Mr. Eves just described. We conservatively did not adjust depreciation, which is a reduction to rate base, in updating this for purposes of LFE 1. I think this is where we just were. Yep.
Yeah, thank you. Then this is the line is this. This is on the DIT tab, line 40.
This is another linkage. This item is updated from the filing per RIU 421, which was a clarification and updates to deferred taxes as of the end of the test year. With pro forma adjustments.
Okay. Thank you. Thank you for bearing with me there. That's helpful. Mr. O'Laughlin, just as we've been talking, I just wanted to make sure that I understand what you were describing before about the company's processes for ensuring there's accurate allocation between distribution and transmission. Can you describe what the actual documentation that results from that review process is?
So the classification of assets between transmission and distribution happens on the individual projects. So those projects are categorized in one of three ways. One would be a fully transmission project, a fully distribution project. There could be two projects associated with the one project that are, the assets are split between those transmission distribution allocations. And then there are those common types of projects, as we mentioned, that are the general property. They support both transmission and distribution, and they're allocated by the wage factor. So those are common projects. So every project that is submitted to be included within the plan would have associated with their budgets that classification.
And how is the reasonableness of the classification assessed?
When we're discussing the projects themselves and the scope of work that's taking place, we review, and there are questions asked when the scope is described in a way that it could have both transmission and distribution assets. There are further questions asked in terms of which assets are being classified in different ways. Typically, in the reference to the 7-factor test before, it has been applied to the standard assets that we install, through the regular course of business over many years. So we have defined which assets fall into which classification. The issue here, as mentioned, that was identified was the specific nature of those general property investments and what they were intended to support, and what was driving the need for the installation. That caused a need to look and reassess and ensure that that classification accurately accounts for the nature of those investments.
Yeah, if I could add a little bit more, and Mr. O'Loughlin could pick back up here too, just the overall IP governance process that you've heard described with the 5 different stage gates, particularly at IP2, where there is a strategic review group that is looking at the specific need and assessment and solution that is being brought forth. That's a very thorough review of each individual project itself. What is this from an electrical perspective? Where again is the need on the system? What are the solutions that are in place? And is this the right approach? There would be a lot of that discussion that would happen at that point. Further, during the IP3 or IP4 reviews, as part of what we describe as our ESP and GSP governance and review team, those discussions would come up on a project specific basis as it gets brought up and reviewed for either the first release of funds or coming back later at an IP4 level for any change requests to those projects if they did need them. That's where a lot of that conversation would happen, and those teams or those review groups and the governance groups are made up with vice president level and senior director level executives across the company, particularly at UI. Mr. Eves serves on that strategic aspect from the ESP, GSP. So does Mr. O'Loughlin. So does myself, as well as a number of other of our executives for those responsible for our overall execution of the projects, those responsible for our overall regulatory oversight. Mr. Canavan is on that review group as well. So there's a number of different avenues and aspects where that conversation would be challenged, take place, and occur. After it goes through the actual execution of the project, the capital spend, the investment, Ms. LeBerg and her team with the actual closeout of a project and a review of what is going into which FERC account. Is it going into the proper FERC account? We're not perfect, I think, as we've talked about here today. And there are times in which we need to go back and reassess. And that's what part of our overall process helps ensure as well, that there are checkpoints if something is new information, such as how is this project evolving, particularly in the common projects we've discussed and what goes into general or intangible plant. We're going to take a look and ensure that we have made the appropriate classifications from a FERC account perspective as we need to.
Mr. Path,
Yes.
before we leave the pages on the screen, I mentioned there's a linkage between this number on the DIT tab to the revenue requirement. That linkage is to Schedule B7. And just a further clarification, as we've discussed, certain of the inputs were updated as part of LFE1. None of the calculations in this spreadsheet were changed. It's only the inputs.
Can you say that one more time? I just want to make sure I understand what you're saying.
Sure. In LFE1, the inputs to the plant model were updated in certain circumstances. None of the calculations were changed.
Okay. And when you say none of the calculations were changed, are you referring to the plant model itself?
Yes.
Okay. Those are all my questions. Thank you.
Thank you. Mr. Capozzi.
I do not have any questions, Chairman.
Thank you. Mr. Bacalina.
I do not have a question.
You do not have a question. All right, I believe that completes authority staff's costs. So we will call up the Office of Consumer Counsel, please.
Yeah.
Good morning. I'm Wheel for the Office of Consumer Counsel. Starting with late file 32, attachment 1, and I guess the narrative response. It's looking at this, it's my understanding that the forecasted rate year column on the right-hand side was derived using the forecasted calendar year data. Is that correct?
Yes, that is correct.
Okay. And how did the company develop the forecasted calendar year data?
Right, so in order to develop the forecasted plant additions by calendar year, we have to first start with the projects and the forecasted capital expenditures. Based on the nature of those projects, when assets are going to be placed into service and used and useful, we are able to then calculate the forecasted plant additions by calendar year.
Yeah, I understand that. I'm just curious how you know, like how is the company forecasting when a particular project's going to be used and useful? Is that just based on like the project schedule?
Right, the project schedule and the forecasted in-service date.
Okay. And what's the there's obviously differences given that the rate year column has 3 kind of buckets for each of the 3 rate years, and the calendar year section has 4. I'm just trying to understand, does that mean that the forecasted rate year columns don't reflect the actual in-service dates for some projects?
The rate years span calendar years.
Yeah.
They span from 2023 to 2026.
Okay, so in developing the rate year projections, is it basically like you're just cutting off you're just kind of moving all the same data using different cutoff points between rate years as opposed to calendar years?
So the forecasted plan additions, they're done by calendar year, but for the the out years, 2024 through 2026, we do not have a monthly forecast for the plant and service additions. So historical plant and service rates were utilized to normalize the calendar year forecast into the rate years.
Okay. So that means, like I asked before, that the rate year section includes some data that isn't based on the project schedules for plant and when plant is going to be serviced on a per project basis.
The plant, it is based on the calendar year that the plant is planned to be placed into service for each project.
Okay, but I thought I just heard you say that you're using some historic data to kind of to make some projections. So it sounds like there's some data in here that isn't, as you just testified a minute ago, based on the per project plant and service date. Is that accurate?
They're based on the per project plant and service dates by calendar year, and it is normalized to the rate years.
Okay, can you just say again what you were saying before about historical plant and service data then? Because I'm getting confused.
Right, so because the rate years span from September 1st through August 31st, in order to determine what the plant and service by rate year would be, we would need to have a monthly forecast within the calendar year of the monthly timing of when the calendar year plant and service amounts would be going into service.
Right. So couldn't you have just done, like, in deriving the calendar year projections, you're looking at the actual projects and their anticipated in-service dates. So all of that is based on actual data. But now what I'm hearing is that in converting to rate years, couldn't you have just, again, looked at all the projects and figured out, done that division by the September and August, kind of looked at all the data and reorganized it again the same way that that you developed the calendar year forecast?
Yeah, so in order to do that, we would need to have a monthly, a forecast for all years by month of the plant
Okay,
and service additions.
I see. So is the idea that the data, that the projected plant and service date on a per project basis doesn't tell you this is going to be done by October 2026? It just says 2026?
In some instances, for larger projects that are ongoing, yes, we would have a planned month and service date.
Okay, but some not, like some it's just the calendar
Correct.
year?
It would be
Okay,
planned to complete within the calendar
okay, thank you. So did the company do a rate year plant and service projection as provided in LFE 32 attachment 1 prior to, like, as in developing the revenue requirement in its application, or did it just do this just in response to this late file request?
If you review OCC 84 attachment 13, which is the version of the plant model that accompanied the company's initial filing in this proceeding, you will see similar information. It's formatted differently, but conceptually similar.
Okay. I'm just curious, like in developing the rate year, the revenue requirements by rate year, when you're considering the plant and service to determine the rate year revenue requirement, are you using the rate year plant and service projections?
We're using the process Mr. O'Laughlin described.
Okay. And by that you mean for a particular project where it isn't narrowed down by month, you're using historical data to kind of figure out which side of the September August division in a rate year to put a particular project?
That's right. If you review the plant ads tab of either OCC 84 attachment 13 or LFE 1 UI attachment 2, you'll see the historical data that we use to do the calculation Mr. O'Laughlin described.
Okay. Thank you. I have a number of questions about LFE 35, specifically the attachment 1. that benefit cost analysis for the distributed automation program. I assume most of these questions are for Mr. Eves. I guess the first question is, it's my understanding that the distribution automation program the purpose is to reduce outages on worst performing circuits. And those worst performing circuits are based on 4-year non-storm safety data. That's how they're identified, that is?
We evaluated in the benefits, both the storm and non-storm. We did eliminate Isaias due to the fact that the destruction would probably limit the ability of the automation to reduce the outages.
Okay.
We did include both in that analysis.
Yeah, well, I saw the analysis that there's separate BCA analysis for storm and non-storm, but my question, I guess, more broadly was in identifying which are the worst performing circuits. Was that on non-storm safety or all-in safety scores?
We looked at the circuits that did not achieve the 0.64 threshold set by Pura to identify the circuits that we would incorporate here.
Okay, and is that 0.64 threshold based on like which safety standard is that threshold for?
That was set in a docket, a prior docket.
171203 RE08. But
it was not. It was previous to that.
Okay.
I have that reference in my testimony.
Okay. Thank you.
So the intent there was to identify the customers that are not getting, on average that reliability benefit, and looking to see if there was a solution for them that was cost effective. And I think the result of the study shows that correcting those circuits produces a relatively minimal impact to system performance, but would improve the experience of those customers. And when you look at the all-in societal cost to those customers of having those outages, I believe that the paper demonstrates that it makes sense for those customers to execute those projects.
Okay. Is the distributed automation program a reliability or a resilience program?
The benefit tapers away as you get into very extreme weather. So I think at its foundation, it is a reliability improvement program that would have resilience benefits in moderate level events, but not in. I think resilience would lean more toward eliminating the cause of the outage. What this program does, and really what the analysis shows, to eliminate the cause of the outage is much more costly. The outage happens here. This minimizes the impact, and the cost to minimize that impact is generally lower than eliminating it. So I would characterize it as moderate resiliency benefits, but relatively significant reliability benefits to the customers that it helps.
Thank you. That makes sense. So I saw a couple of references in here that indicate that the plan is to start at the worst performing circuit and work the way up, sort of across across multiple rate years. So does this mean the company's going to target the circuits with the highest circuit level safety first? Is that the order?
Yes, to target the ones that would provide the most benefit first.
Okay. That's the highest, again, basically looking at the circuits that are beneath that safety threshold, above the safety threshold that's set forth and that's referenced in your testimony.
Yeah, docket number 1507-38.
Okay, thank you. So looking at, I'm looking at table 3.1 on page 2 of the late file exhibit. Are these these are 16 circuits, and these are what's being proposed to start with in the 2023 program? Is that accurate?
I'm sorry, could you give me that reference one more time?
Yep, it's table 3-1 on page 2. Well, sorry,
pages are-
page 11.
Page 11, thank you.
Yep. I'll only use those top number pages, numbers from now on.
And I'm sorry, and your question was?
Just making sure I understand, these are the 16 circuits that are being proposed for the 2023 to start with in 2023?
Correct.
Okay. Circuit 1685, is that the same circuit 1685 that's identified in OCC 507?
Let me look at OCC 507.
Specifically attachment 1 to OCC 507?
507. Yes.
Yes. So looking at that's on the last line of that attachment, and that seems to show a 4-year average safety of 0.6330 for that circuit, right?
OCC 507. Sorry.
So I was just curious why that was in here if it's below that 0.64 threshold.
OCC 507. Okay. Check that. Okay, Attorney Wheel, I'm doing some analysis on the fly here. I'm sorry, what line number on the Excel spreadsheet are you referring to?
Is the very last line on OCC 507 attachment 1 that shows circuit 1685. And then I'm looking at the column on that spreadsheet showing the 4-year average safety. And it's showing a 0.6330. Do you see that on that exhibit?
I see that. Let me, so the average in the report was 19 to 22. The table that we're looking at here is 18 to 21. That circuit did have 2 years where it was above, and it was very close to the threshold as well. But the 19 to 22 average, I believe, subject to check, is 0.82, which would put it above that threshold.
Okay. Thank you. Looking at page 3 of the exhibit, which just lists at the bottom there the 4 solution alternatives, the remote ECC control, sequential reclosing, ARA, and loop scheme. So is the idea that all 4 of these alternatives are potentially a solution to the 16 circuits identified here?
They could be, depending on the application. I think our evolution would move toward the ARA solution. There will be some change management and learning curve there in getting our line workers familiar with and comfortable with the fact that automated operations will be occurring on the system and ensuring that we have all the processes in place to keep them safe. But in its final outcome, looking at cost as well, and you know the conditions on the circuit, the ARA would be the most advantageous if the cost and exposure lines up to need it.
Okay.
But I think that toolbox would be applied situationally.
Okay. So is it fair to say that the goal then is for each circuit to apply the ARA solution, but that if there's some reason that doesn't work, then the idea would be to look at the other three options?
Correct.
Okay. And can you just, in layman's terms, to the extent it's possible, and quickly just to explain what each of these solutions does and what the differences are between them?
Sure. So a tree comes down across a circuit. Remote ECC control means that a human in our ECC can see the fault currents that occurred and can identify which section of the circuit that tree came down on and can isolate it from the ECC without seeing it. Sequential reclosing is if it occurred on if you have three sections of the circuit from the substation out and it occurred on the third circuit, it would close back in looking to see if there was a problem, and move on from that point automatically to get as much of the circuit back as you could. Now, if it fell in the first section, that would be limited because you're not coming back from the other side. Advanced restoration and automation would be to use the tie points to sense, to have voltage monitoring, current monitoring, really a fully automated suite of sensors to understand as much as you can about the status of the system. Is it a single conductor break? Is it three conductors? How much fault current was there? How much load is there on the circuit? Be able to understand the loads as you switch back to see where you are. And then the loop scheme would be a step back from that, being able to restore from the other side, but not having that, all those inputs. You're simply getting the power back onto as many customers as you can.
Thank you. So ARA, does every circuit have feeder ties?
I wouldn't say everyone does. I mean, we have circuits that feed capacitor banks and things, but in general, most do.
Okay. And it would require, to implement ARA would require that a circuit has feeder ties then, right? And do you know whether all the circuits identified in that table, the 16 circuits that are being proposed, have feeder ties?
Yes.
Okay. And has the company confirmed that all of those 16 circuits have adequate capacity to handle the additional load transferred once distribution automation is implemented?
So that is a conditional question. I mean, things can change over time. In general, 99% of the year, there is adequate capacity. As loads develop, there may be a situation that certain size transfers cannot occur. But most of the time on a day like today, we would be able to leverage ties to execute this transition. And again, that would be the benefit of the ARA to understand where we are with the load conditions at the time.
So when you say most of the time, 99% of the time, I think you said there's adequate capacity. Sounds like is that a kind of a general statement that's applicable to the system in general and not specifically applicable to these 16 circuits?
Yeah, I may have used that 99% metaphorically, but there are many hours during the year where there would be capacity available to leverage the majority of these switching steps to restore customers.
Thank you. On page 4, there's a statement right at the top. The proposed devices aim to create customer pockets, limiting each to less than 500 customers and/or 10 miles of overhead line. Is that is that a guideline that reclosers have already been installed under?
No, and 10 miles on UI system that's a long span as well. In general, this is a guideline. You want to theoretically you want to break it up into smaller pockets of customers. You're also looking at the exposure, and you're looking at the topology of the circuit, the way it branches. So ensuring that if you have a long linear circuit, that's a different application than if you have a tree branch. So in general, you want reclosers on each of the branches because you can protect the other customers. If you have a linear application, then I think these things apply. In general, UI system, the way our roads are here, we're not upstate New York or Maine. There are many branches on our trees, and we generally apply those reclosers on the branches.
Okay. So is this, it sounds like this maybe is a more like an industry standard that's kind of generally applicable to, I mean, I guess my question is this a result of the fact that this analysis was prepared by a consultant firm that wasn't specifically internal to UI?
I mean, that's a general automation concept that when you apply automation, we'll typically have, anywhere between 1,000 to 3,000 customers on a circuit. You want to break the circuit up into 500 customer chunks and limit the exposure to trees or other failures that each section has, and protect the other customers from that exposure on that section.
Okay.
And again, it's heavily dependent on the topology of the circuit.
Do you know how many reclosers are currently installed on the UI system?
A little over 400.
Okay. And can UI currently control any of them remotely?
We do not control them remotely today. And that has been, looking at the cost benefit of that over time with our reliability performance. This view of looking at the specific customers, we have not moved to automate them because of that, because of the cost involved with creating that automation. But I think when you look at it in this way for those specific customers, I believe in the case that was made here.
And the 400 circuits that are currently on the system, do they need to be replaced in order for these solutions to be implemented?
Some of the older ones may, based on end of life, may require replacement. In general, they are outfitted with the ability to put communications in their control cabinets. So the idea would be to leverage the ones that have remaining life and outfit them with the appropriate communications.
Okay. So what we talked about a minute ago, that the plan was to start with the highest safety numbers of the identified worst performing circuits and sort of work on priority there. Would the idea be that there'd be a sort of second level or maybe first level of priority to start with the circuits that don't need to be replaced? Is that what you mean?
No. So what we would do is leverage the existing reclosers for those solutions, automate the existing ones, and then there was a table there that listed how many new ones would be required. It was basically one or two to optimally create the configuration and topology to automate it.
Okay.
So most of our circuits with the 400 reclosers we have deployed have a recloser on the branches, have a tie recloser. We took another look at these circuits to optimally automate them. And it required one or two more reclosers to do that. And that automation is providing value today. I mean, it is sectionalizing and reclosing. So what the recloser does is, for a temporary fault, it opens and then closes back in. A significant percentage of the faults that occur are a tree branch falling through a power line or an animal contacting a power line, and it's there and it's gone. So the recloser allows us to eliminate those outages and just create momentaries from them.
Thanks. This question goes back to something you were just discussing a minute ago regarding identifying alternatives, I guess, and you were talking about identifying outage prevention alternatives as opposed to this mitigation strategy. So has the company looked at preventive alternatives for these 16 circuits and priced that out, like done the cost comparison?
So we have programs in place today that result in a baseline of outages. And one of the elements we've discussed here is the UPZ program, right? 50% of the system is completed. We're working on the remaining 50%. So I believe we have programs in place to create a baseline of reliability performance that's within the threshold. And I think the argument with this approach, that 0.64 target would assume somewhere above and somewhere below, right? To hit it or stay below it.
Yeah.
So I think with our performance, last year of 0.44, the programs we have in place are delivering on average for our customers the reliability benefit we're trying to achieve. This is an approach to improve it for those outliers.
Right. And for the outliers, you mentioned before, I think that alternative solutions that are targeted more specifically to prevent outages would be more expensive.
They would be.
And so has the company done an analysis demonstrating that?
So there's a variety of outages that occur in the system. So some of the outages that occurred could be car pole hits. We had a significant one of those the other day on Friday. Those are random and are difficult to eliminate. Even with UPZ, there will be, trees will come over and impact our facility. So to drive toward eliminating those outages and be sure that you've eliminated them would be very costly. I mean, orders of magnitude more than the handful of millions a year we're talking about investing for these solutions.
Yeah. Well, that last statement that you said that I'm just trying to get at, is it, I understand. So I guess the question is it theoretically orders of magnitude more expensive, or is there data? I mean, I understand the idea is you could invest some, with limitless resources, you could reduce carpool hits, building
Move them off the
walls
road.
or whatever. Like
Move the poles 100 feet off the road.
Right. So is the idea that those sorts of solutions are just like the company's confident that the level of expense for those sorts of solutions is so beyond what's being proposed here that there isn't a reason to actually, like, the company hasn't looked into pricing out how much it would cost to move the poles 100 feet from the road, correct?
We have not priced out that alternative.
Okay, so the convoluted question I was just asking before is the reason that hasn't been priced out is that there's no confidence whatsoever that the result would be that it would be more cost effective to do something like moving the poles 100 feet from the road.
So if you look at the variety of efforts we have underway to maintain our reliability, vegetation management, being an example. Right now, we've got a program that, through discussion in this case, it will cost over $200 million to create a 8-foot ground to sky zone around our facilities. To extend that would, another 8 feet would I think theoretically be another $200 million to improve that performance. So I think the orders of magnitude to eliminate the outages in comparison to this mitigation technique, from an engineering assessment and 30 years of experience, indicates that this is the most cost-effective method to provide that reliability benefit to these outlier customers, and not attacking the causes of the outages directly because of that cost-conscious approach.
Thank you. I understood. On page 4, sure, I'm looking at the right page. Down in the last paragraph towards the middle, there's a sentence that says UI engineers identified specific outages over the last 4 years, which would be mitigated by the new recloser based on its exact proposed location. Did UI take into account the possibility that future outages won't be in the exact same location or at the same frequency as historical outages?
That is an approach we could have taken, but we replayed the outages that actually occurred, to provide this view of what the future could look like. Those are things that kind of kicked around in our heads. We could, take a probabilistic view of the, the lines and the conditions and apply a more pro forma view, but we thought replaying exactly what happened in the past and what would happen if we had these reclosers in place to look at that benefit was a defendable and reasonable approach.
Okay. And but there's a certain amount of, I mean, with any projection, there's a certain amount of uncertainty built into that, right?
Yes, there is.
And is that uncertainty accounted for at all in estimating the future benefits in this analysis?
One of the uncertainties we accounted for to try to keep it on the conservative side was not including the Isaias impacts, because we're not confident that the automation will work. Generally in an event where we have 1,492 multi-customer outages across the system. So I think we applied conservatism in that way, and I think for playing the outages that occurred is a relatively straightforward approach to analyzing that.
Thank you. I'm going to look again at table 3.1 on page, I think it was 11. Yeah. So I see the overall on the last line, the overall percent reduction is 6.8%. I'm curious about these 5 circuits, the first 2, then circuit 2688 and circuit 3638, that all show a 0% reduction. Does that mean that the proposed DA solution wouldn't reduce non-storm outages on those particular circuits?
It just means that that in those 4 years an outage didn't occur on that area. So over time, if you look at 20 years, there would likely be some benefit.
Okay, thank you. And going on a similar question on the next page, looking at table 3.2, which is the avoided interruptions for storm outages as opposed to non-storm, which is the last table. I'm seeing that for 4 out of those 5 circuits, there are percentage reductions. And it's interesting because it tracks actually. Sorry. So let me make my question simpler. Looking at this table, there are 1, 2, 3, 4, 5 total circuits that show any percent reduction at all. Correct?
For storm outages that occurred during those 4 years.
Okay. So that's the reason for the circuits that have 0% on this table are circuits that didn't have storm outages over those 4 years. Correct?
Yeah, correct.
Okay. I'm just curious why.
I'm sorry, that didn't have storm outages where the automation would have provided a benefit.
Okay. Gotcha. I'm just curious why. So, for instance, the first 2 circuits, 1604 and 1685.
Let me be clear with that too, because it's not that they didn't have outages, right? So these outages have to occur on the mainline sections that are being protected. So we have fuses that are going off into the neighborhoods. So those outages will continue to occur. These are mainline outages occurring on these circuits during the 4 years we looked at.
Okay.
With storm.
Thank you. So looking at the first 2 circuits, 1604 and 1685, those were 2 circuits that had 0% reduction in the prior table, but they're two of the only circuits that show a percentage reduction in this table. And that's actually true of all the 0% circuits from table 3-1 all show a percent in table 3-2. There's an outlier here, which we'll get to in a minute. But is there a reason? Is that just a coincidence that
It is coincidence. So, I mean, what has to happen is a tree or some element has to come over in a storm event, right? So the winds are, there's a variety of storm events that occurred here, but what it's showing is if for non-storm, we did not, in some of these instances, we did not have a mainline event, but during storms we did.
Okay.
And in some, we had, had both.
Okay. And so the significance that I said a minute ago, there was an outlier. I was referring to circuit 2642, which shows the table shows a percentage reduction on both of these tables. But again, that's just coincidental based on what's happened on that circuit in the historical
In
data.
non-storm and storm conditions, yes.
Okay. Thank you. My next set of questions are about table 3-4, which is on page 14. Looking at circuits 36, 35, 500, just those two to start with. Those show a benefit cost ratio of less than 1, right?
Again, for playing those previous outages out, they do, yes.
Okay. So that's also a symptom of just using the historical data. So got it. Sorry, I'll retract that question. I understand. And the same is true for 36, 38, which shows only 1.1. That's just the results of using the historic data. Okay, thank you.
Now, you raise a good point. I mean, to the extent that those happen in the future, would you not do those circuits? That is a consideration.
Thank you. And this table, I think it's the only table I saw in the report that shows benefit cost ratios, but it looks like it's mixed between those two previous tables because this is non-storm and storm. Has the company also used only non-storm and only storm analysis data to show benefit cost ratios for?
So we use this, and when it says non-storm and storm, Isaias is excluded. So the conclusion we made is the other storms that occurred during this event did not have the destruction that would significantly mitigate the value of this automation. So most of it, we believe, would be applicable in the other storms that we had in that time frame.
Okay. So it's not, that reference isn't meant to indicate that this is a mix of the data from the prior two tables, which are identified as non-storm and storm outages.
I mean, I think it's representative of what the customer experience would be, because the customer experience is going to include both. So I think this table demonstrates I think the true value to customers for executing this program.
Okay, thanks. Looking at footnote 1 on this same page, says the estimated cost per recloser is $100,000. Then the communication and infrastructure cost estimates a total of $2.18 million. How were those communication and infrastructure costs derived? Like, how did the company get to that 2.1?
So we looked at the infrastructure necessary to protect the transmission system and to implement the integration to the SCADA system that will allow the control of these devices, and then the integration over to our outage management system, so our system operators have situational awareness, as well as the backhaul for the communications out to the reclosers. So those estimates were put together by our SCADA teams and telecommunications teams.
Okay. And do those costs scale as along with recloser installations, like if the 2023 program includes 10 reclosers on 10 circuits, would the communication cost be lower
That's it.
per circuit?
So that there's a foundational cost to establishing the back end platform in the SCADA and OMS that is, if you have one recloser or 100, you have to do that.
Yep.
Then there are, what's the word? Scalable costs for deploying the communication infrastructure that's going to send the signal from the substations out to every recloser. And then the recloser estimate would have the radio, cost for communication within that. So that end use cost is included in the recloser cost. There would be some scalable communications to be able to get that signal out to all of the 80 circuits eventually.
Okay. Thank you. Is there any lag between the time when a recloser, when the solution is implemented, and when it's operational? I guess the question is, in terms of what we were just talking about with the communication infrastructure, I assume that some degree of the kind of background infrastructure needs to be set up first, correct? So is the plan is the order of operations just to get that stuff built first and then be able to connect each new recloser?
It's to develop them in parallel, and putting the recloser in, there are supply chain elements that, to getting those ordered and getting them in stock that, but in general, as I described earlier, if we're going to implement it, there is benefit in putting it in without the communication. So I think our plan would be to order them, get them implemented on those areas. We can use them as sectionalizing devices at that point, and then work in parallel with the foundational infrastructure and the change management we have to do, with our line workers and ECC personnel to ensure that we're able to do this safely 100% of the time.
Okay. And this cost benefit analysis is just for the 2023 plan. So it's not accounting for what would come next in 2024, any subsequent rate year, right?
I mean, I think it's demonstrating directionally the outcome of the analysis, but the specific analysis, looking at every circuit, replaying the outages again, we're gonna, we're working on completing that for the remainder of the program.
Okay, that was gonna be my next question. So there's a process already underway of conducting a similar analysis for the subsequent rate years?
Yes.
And do you know what the plan is is that gonna be proposed to Pura, or do you know if there's some mechanism for the authority to look at that?
So we've put the plan for the next 3 rate years in this case. I think there will be some indication in the decision and the instant docket of the direction here. There may be orders in this case to report on the outcome potentially. I think would be tools that I've seen used in the past.
Okay. And when you say the plan for the next 3 rate years is in this case, do you just mean that the plant and service costs are accounted for in the expected cost for implementing this program each of the rate years is in the
For
case?
continuing to implement it, yes.
Okay. Does UI have any other programs for addressing worst performing circuits?
So we have repetitive compliance filings every year to look at this. I think this is so we look at that every year. We look at worst performing circuits. This is an approach using automation and the outcome of the resiliency docket to address this issue.
Okay. So is it fair to say then that so far that there's just a tracking, like the company is just tracking which circuits are the worst performing? But is there a program in place to specifically address those circuits like this program would?
So what we would have done in the past is we would have gone out and looked at the causes of the outages and implemented some remedial actions towards those causes, intended to improve the performance. I think this analysis looked at the societal cost to those customers and whether it was worth investing more in terms of automation.
Okay.
To prove that when you look at the all-in cost of society.
And the remedial actions, would those continue when this program, the same remedial actions continue once this program goes into place?
So if we execute this right, these circuits will come off that list, right? The performance of these circuits would improve, I believe. So we'd be performing remedial actions on other circuits.
Okay.
In general.
And it brings up another question. So is the goal then to eliminate all circuits that fall above that 0.64 threshold?
That would be the intent of the program to do that analysis and attempt to implement solutions that would do that.
Okay. And if the company reached that point, would there be a reason to continue? Would the company, do you think, propose lowering the threshold from 6.4?
Actually, that's an interesting question. I think what we did was we looked at the situation where deploying the solution would have a positive business case in general. So I think that would be the threshold for this program, right? It's not necessarily driving every circuit down below 0.64. It's doing it where that outcome is going to produce a positive impact on our customers. And where it doesn't, I think that's where you stop doing it.
Okay. Going back to what we talked about, and I'm almost done. Thank you for your patience. Going back to what we talked about at the beginning, that the plan is to start with the worst of the worst performing circuits, the highest level, the highest number of safety results, and sort of work your way back. Just curious how that reconciles with the spend plan, which increases over the course of the rate year. Specifically, the question of the incremental benefit, system-wide benefit, decreases as you're improving the worst performing circuit list, but the costs are increasing, right?
So I think factored into that are some of the supply chain issues we may encounter in getting the materials and the timing of the program. So I'm not sure that there's a direct relationship there. I think we structured the spending based upon a number of factors.
Okay. And last question, has the company filed the underlying data and calculations that were used in this BCA to support selecting the specific circuits and any other information that's in these, like the table 3.3-1, 4, and 4-1?
Today, we final just the final report.
Okay. And that is the OCC's last question for this panel. Thank you very much. Thank you, Chairman.
Thank you very much, Attorney Wheel. Attorney Bidra?
Good morning, Chairman. Good morning, Commissioner. Good morning, Council. Good morning to the panel. Realize I'm standing between you and lunch. So I'll try to stay true to my approximate estimate for cross. All right, let's get started. Are you familiar with the company's agreement to remediate English Station in 2015 as part of its change of control proceeding?
Good morning. Could you repeat the question, please?
Absolutely. Are you familiar with the company's agreement to remediate English Station in 2015 as part of its Iberdrola change of control proceeding before PURA?
I am.
I just want to make sure the name tags are correct. Is that okay? Thank you. Thank you. Is it correct that UI agreed to investigate and remediate certain environmental conditions within the perimeter of English Station?
That is correct.
UI agreed that if the investigation and remediation costs were under $30 million, it would remit to the state the difference between the cost and the 30 million. Is that correct?
That's correct. There was two conditions within that order.
Do you agree that a purpose of UI's agreement to investigate and remediate English Station is to provide a public benefit estimated at $30 million?
Could you restate that, please?
Do you agree that a purpose of UI's agreement to investigate and remediate English Station is to provide a public benefit estimated at $30 million?
I was not specifically involved at the time, but I've heard that before.
Is that, I would just perhaps add, that, up to the $30 million is what had been agreed to.
Okay. And Mr. Mullen, just to get a frame of reference, when did you become involved in the English Station for the company?
Late 2019.
And in what role did you become involved in English Station?
I was the manager of the environmental remediation group for Avangrid Service Company.
Okay. And are you still an employee of Avangrid Service Company?
That is correct.
Okay. Do you agree that in your response to OCC 610, that the company has spent approximately $16.7 million from January 2017 through January 2023 on English Station?
That's correct.
Okay. And would you also agree that attorney's fees and any direct time charges of the company's employees, managers, or officers are not to be included in the $30 million public benefit?
That's correct.
Okay, let's please refer to late file exhibit 60, which was supplemented. Is it correct that at the end of the first paragraph, the company states, no costs related to English Station's environmental remediation were reflected in the revenue requirement approved by authority in what was docket number 160604, or the company's last rate case?
That's correct. That's what the response states.
Is it also correct that there are no internal costs for English Station included in the revenue requirement for the current rate case?
As described in, I can't recall which data request response, but there was a data request response where we described that the initial filing inadvertently included approximately 300,000 of such costs that were subsequently removed in LFE 1.
Okay. Okay. And if you could recall back to the February 24th hearing, do you agree it was your testimony that the company has never allocated external costs for English Station to ratepayers?
I do recall that.
Okay. During that hearing, there was a discussion about internal versus external costs for English Station, and I want to be very clear about this. Has the company charged internal costs for English Station to ratepayers?
No, as we described in this response and our supplemental response to RRU 367, UI's base distribution rates have never included amounts related to English Station environmental remediation.
Okay. And also the current rate case request does not, is it correct that the current rate case request does not include any internal costs related to English Station?
After making the correction I described earlier, that would be correct.
Okay, and I do want to talk more about that correction in late file exhibit 1, and I would like to please relate it to late file exhibit 61 attachment 1. So if you could reference both, please. So starting with late file exhibit 61 attachment 1, is it correct that approximately $5,021 in environmental remediation costs were allocated to UI distribution? That's line 14.
I do see that.
Did UI make any adjustments to remove these costs from the test year?
That's a good question. This attachment summarizes the costs as headered in the unadjusted test year. So this presents our books as they were. And then the revenue requirement includes an adjustment to remove, subject to check, approximately $300,000 of legal costs.
And when you say the 300,000, that is what the company listed in late file exhibit 1.
It's what was removed in LFE 1. There was another response that I just cannot recall the number of, itemizing that. Actually, it may be OCC 610, which you pointed us to previously.
Okay. Okay, so I want to make sure I understand. Does late file exhibit 1, and let me get you a page reference so we all have an accurate record.
Thank you.
Excuse me. Late file exhibit 1, page 4, removes approximately $311,000 in costs related to English Station, correct?
Yes, that's correct.
Are there additional costs that the company is removing from the revenue requirement not included in late file exhibit 1?
No, late file exhibit 1 reflects everything we intend to remove. And just to clarify, because I quoted 300,000 of legal, and then LFE 1, as you just noted, reflects 311,000. The vast majority of that 311,000 is legal expense. And then there are, I'll call it cats and dogs sprinkled throughout the other schedules that are much smaller. But yes, LFE 1 reflects the removal of all English Station related costs.
Okay, and to continue on, please, with late file exhibit 61, attachment 1, line 27. Could you please explain what that line is for English Station remediation expense?
LFE 61 UI attachment 1 provides information regarding the company's legal expense in the unadjusted test year, broken down in slightly more detail than we presented our initial legal expense schedule as requested by Attorney Wheel during the initial set of hearings in this case. So there are a couple of lines that relate to the company's English Station remediation efforts, and this is one of them.
So what does the negative $2,111 mean for the revenue requirement?
That would not be included in the revenue, in the rate year revenue requirement. Again, this is the unadjusted test year, so the company did incur costs, and that's why they're summarized here, but we removed in the rate years all English Station environmental remediation costs.
Okay. In line 28 of the same attachment 1 to late file exhibit 61, there are approximately $110 in English Station site legal expense costs, correct?
Yes, I see that.
Are those costs also excluded by way of late file exhibit 1?
They are. Again, subject to we incurred them in the test year and then removed them in the rate year description.
Okay. And then finally, line 16, late file exhibit 61, attachment 1 is for state regulatory matters. Do you agree there's approximately $408,281 on that line?
I do.
Are there any costs related to defending issues or allegations of noncompliance with the English Station remediation reflected in line 16?
I'm just pausing because we discussed the 300,000 of total legal costs, approximately 130,000 of which is the 2 lines labeled English Station. And then while preparing the response to OCC 610, we determined there was approximately 170,000 of additional costs that needed to be removed. I think that was in this line, but I'm not 100% sure.
Chairman, may I request a read-in to obtain clarity?
Yes, so that'd be read-in 2 is to clarify, oh shoot, what row was that? Yeah. Okay, clarify whether row 16 was encompassed in the 300,000 removed for English Station.
Do you mind if I confer for one moment to see if we can get that right now?
Sure.
Read it will be best. Thank you.
Okay, thank you. Okay, moving on. Same topic of English Station, just pivoting slightly. How many project managers has UI had for the English Station cleanup?
There's been 2 since my time, since 2019, and I believe there was 3 before that, so maybe a total of 5. Subject to check, I don't know specifically, but that in that neighborhood.
Okay. Would you agree that there have been 6 project managers for English Station
That
since?
could be the number, yeah.
Okay. Has replacing the project manager 6 times delayed the remediation at English Station?
Not to my knowledge.
Has replacing the project manager 6 times increased the cleanup costs at English Station?
Not to my knowledge either, no.
Okay. Since your time involved in English Station, Mr. Mullen, why have project managers been replaced?
The first one, he took another position in the company as an advancement. The current one actually was an assistant project manager on the project, and he's with us. Before then, I'm not exactly sure why.
Okay. And who is the current project manager?
His name is William Burgess.
Were you ever a project manager?
Not for English Station, no.
Okay. Have any of the 6 project managers for English Station received loyalty awards?
Specific to English Station?
In
Is general. I believe so. At least 2 that I'm aware of.
Would you please state their names for the record?
Sean Crosby
And William Burgess, I believe, has received a gratitude, same as I think of what you're referring to as a loyalty.
Okay. Is it possible that project managers before your involvement received gratitude or loyalty awards?
I was a project manager for English Station in the early 2017 timeframe.
Have you received a loyalty award, Mr. Eves?
I'm not define loyalty award.
Under the parameters of late file exhibit 85, which I'm not sure if you have up, in which the company elaborated upon what a loyalty award is. I can make it simpler if you don't have it at your fingertips.
Okay.
Subject to check, do you agree that late file exhibit 85 states that loyalty awards include retention payments of approximately $30,000?
That is listed in the response to the late file.
Okay, so then I'll just repeat my question. I'm trying to learn which project managers for English Station, which you included yourself in that category, have received loyalty awards, as we just went over from late file exhibit 85.
Yes, I appreciate the question because it's a good way to sort of work our way through what has happened over time and the project managers that have been involved and what sort of indirect, secondary, or tertiary type costs may be associated with those project managers. And as we see in LFE 85, the loyalty awards that are defined here relate to retention payments and sign-on payments. I can let Mr. Mullen speak directly for the individuals that he's aware of, and we can go back and confirm to make sure. But in respect to retention payments or sign-on payments, I am not aware of the individuals associated with being project managers of English Station having received either of those in that time frame. Mr. Mullen, do you have any different insight?
Thank you for that clarification on the loyalty payment. I was thinking more of a gratitude to an employee. Only the two that have worked as long as I have, William Burgess and Sean Crosby, a gratitude, which, just an employee gratitude. Thanks for a nice job for many different reasons, not specific to that project.
That's also a good clarification. They have responsibilities beyond just English Station.
If the company is not able to answer whether any of the 6 project managers have received loyalty awards within the company's own definition in late filed exhibit 85 now, I would please like to request a read-in.
Okay, Attorney Benora, is this information available in the timeframe that a read-in will allot?
I think Mr. Donnelly has some comments.
Yeah, no, I believe we will be able to get that information within the timeframe of the late file hearings.
Okay, then I'll mark that as read-in 3. So it's referencing LFE 85, and which of the 6 project managers have received, if any, ever received a loyalty gift as described in LFE 85.
Thank you.
Thank you.
Have the project managers been UIL employees or Avangrid Service Company employees?
Since 2019, UI and Avangrid Service Company, and maybe Mr. Eves can help me prior to that.
At the time I had it, I was a UI employee. I moved on to a full Avangrid role in operations after that. The individual I handed it off to, Mr. Crosby, was a UI employee as well at the time.
Okay, and the current project manager, Mr. Burgess, I believe, what company is he an employee of?
ASC, Avangrid Service Company.
Okay, so then to summarize, the 6 project managers for English Station have been employees of both UIL and Avangrid Services Company?
To the best of my knowledge.
Who is the final decision maker for UI's remediation decisions at English Station?
The technical team, which I have responsibility for, we do meet with sponsors made up of legal and some executives.
Are you the final decision maker for English Station decisions, Mr. Mullen?
I am not the final decision maker, no.
Okay, but the team you just described reports to you?
Pardon me?
Maybe I misheard you. Did you describe a team of technical employees who report to you related to English Station?
That's correct.
Okay. And do you report to somebody else about English Station?
There is a sponsor group of executives and legal.
Hi there. It's currently 12:15 p.m. with a
Okay. Are the executives and legal employees of Avangrid Services Company?
I don't really know. I think the majority of them are AMC. I'm not sure if one of the legal is ASC or not.
Okay. Is it correct that the executives and legal attorneys, rather, that you report to on English Station are not UI or UIL employees?
To the best of my knowledge.
Do you agree, subject to check if you don't have it handy, that your response to OCC 610 states there are no internal labor costs for 2021 and 2022 because certain environmental department employees were moved from the UIL Holdings Corporation subsidiaries to Avangrid Service Company and no longer direct charge time for UI for specific projects?
That's correct.
Who are the employees being referred to in this response that were moved from UIL Holdings Corporation to Avangrid Service Company?
That would be William Burgess and Sean Crosby.
What is the main office? Where is its physical location for Sean Crosby and William Burgess?
William Burgess is at 180 Marsh Hill Road, and currently Sean Crosby is at 100 Marsh Hill Road.
Okay, so both have a, call it, home office in Orange, Connecticut?
That's correct.
All right. Would any of the time that Mr. Burgess and Mr. Crosby spend on English Station on behalf of Avangrid Service Company be allocated to UI distribution in any way?
I'll ask one of my colleagues for a little help. I'm not sure how that works in the background.
as Mr. Hurwitz described, we do not have any of the time associated with individuals involved with English Station on the remediation side included in the rate plan. Adjustments have been made. I'll pause to let Mr. Hurwitz fill in any gaps.
I think it was well said, Mr. Donnelly.
Okay, final handful of questions. Do you agree that UI is responsible for security costs at English Station until cleanup is complete?
Yes.
Did UI request recovery of security costs for English Station in this rate case?
One moment, please. No, not that we're aware of.
Is it correct that English Station property was recently vandalized with graffiti on the gate and fencing?
Could you describe what you mean by recently?
I'll rephrase. In the past year, is it correct that English Station property was vandalized with graffiti on the gate and fencing?
We have just looked, ironically, we have just looked at this, and looking back through some historic photos, it does appear that perhaps on the fence along Grand Avenue, maybe within the past year or two, that we're aware of.
How will UI, assuming UI will clean up the vandalism, how will you, under its obligation to maintain security at English Station, how will UI bill for the cleanup costs?
Well, we do establish budgets, every year, and as we've stated that, that comes out of our reserve we set aside for that activity.
Do you agree that UI has an obligation to remediate English Station regardless of the costs?
Yes, it does say that in the order to that effect.
Thank you to the panel. Thank you. Those are all the questions I have.
Very good. Thank you. We are going to take our lunch break, but let me just check so I know where we are starting when we come back. Attorney Marshall, are you going to have cross for this panel? Okay, very good. So we're going to take a lunch break at 1 o'clock. We will return and we will resume with cross for this panel by Deep, please.
No, I'm sorry, but there's only two. No, I know. That's right, you're two, right, you're three.
Take your time with that. Was it a half hour?
The one.
One?
Yeah.
Okay.
I can speak to it out of my head. Yep, no, so I appreciate that. Oh my God. You know. Going against the flow of traffic. Hello.
But we didn't get the daily, so.
Yeah, I don't know, but things could change. But anyway, so tell Teresa, so she knows she's coming in tomorrow.
I will.
All right, thank you.
Oh, I don't know how to find the phone. Yeah, that's all right.
Sorry. I know, I said that when you walked in, I said. That what I should say. Mine is the lower. I raised my hand. This year, yeah. I can read through. Yeah, sorry, I'm not thinking about. Yes.
Again, so very similar.
Good afternoon, please be seated. Okay, we are going to go back on the record and we'll resume cross with deep, as long as there are no administrative matters before we begin.
Chair Jill, we will have one of the redirects at least, but perhaps after the cross.
Okay,
thank you.
very good. Then Attorney Marshall, please.
Thank you. Good afternoon to the panel. Good afternoon, Chairman, Vice Chairman, or Commissioner Karen. I'm sorry. Ashley Marshall on behalf of the Department of Energy and Environmental Protection. I'm joined by co-counsel. I'll allow him to introduce himself.
Good afternoon, Brendan Shane, on behalf of the Department of Energy and Environmental Protection.
We just have a few questions. We're going to pivot back to English Station.
I'd like to start with a follow-up from a question from before the break. You indicated that there had been vandalism on the property in the past year or two. Is that correct?
We're not aware that it happened within the past year or two. We looked at some photographs that looked from a year or two ago that look different than today. So we can't earmark the specific timing of that, but there has been some painting on a fence along Grand Avenue that appears to happen within the past year or two that we've been able to track down so far.
It's my understanding that there have been recent reports from the community of graffiti. So that vandalism that's occurred sometime within the past year or two hasn't been cleaned up?
Some of those discussions we've had following up to meeting with a monthly meeting with the department. As we understand some of the graffiti that's been reported, some is well back into the property on buildings that have been there for a while. And then there's something that looks a little bit more contemporary up along the road on the fence. So that's what we're trying to understand the timing of that.
In your testimony earlier, you also identified a team of project sponsors, including executives. Is that correct?
That's correct.
And those sponsors are the ones who have final decision-making authority about the cleanup?
My understanding, yes.
Can you tell us who those sponsors are?
One is Frank Reynolds, President CEO of the UIL companies. Scott Mahoney, who is a legal counsel for AMC.
Are those the only two?
We've had a recent addition to the group. I'm not sure she's a sponsor, but Kenna Hagan is a UI attorney.
And so those are the folks that have the final decision-making authority over the cleanup?
What happens with the information that we provide to them and who they talk to amongst the other executives, I'm not aware of. I think it's, obviously, I believe that it would go up to the top of the CEO of Avangrid as part of the team that would be involved in those discussions.
And so those project sponsors are employees of both corporate entities, of UIL and of Vanguard?
I'm not very familiar. The mechanics of who they actually are employed by, I would have to have a little bit of help. My understanding is AMC, and then Frank Reynolds is the president and CEO of UIL Holdings. I'm sorry, UIL companies.
And you indicated that there's a team of technical staff that report to you regarding the cleanup?
That's correct.
And the decisions made by the technical staff require approval as to cleanup approaches, let's say, require approval from those sponsors?
As a conceptual site model, meaning what does the nature and extent of impacts look like as we further define that, and we can share that information with the sponsors on what we're finding, any ideas for a solution, they would make the decision. Day to day, activity, collect a sample here versus over there would be made at our level.
I'd like to refer for a moment to the supplement to RRU 0367. In that document, the UI, would you agree that UI acknowledges that in docket 000405, Pure ruled that it would not permit any future costs related to English Station other than bulkhead repair costs to be reverted to ratepayers?
I recall something along those lines. I don't have the exact quote in front of me, but
there's also an acknowledgement that docket number 150738, Pure ruled that remediation costs related to English Station could not flow back to the ratepayers. Is that correct?
I similarly recall something along those lines.
Are you also aware that UI is under a partial consent order with the Department of Energy and Environmental Protection regarding the cleanup of English Station?
We're aware that there is a partial consent order, yes.
And the partial consent order provides that UI must spend $30 million to comply with that order before seeking recovery or funding of costs above that amount from the state or any third party. Is that true?
Attorney Shane, just to clarify, are you asking for legal conclusions on this, or because those sound like legal questions, asking for an interpretation of the partial consent order?
I'm not asking for an interpretation. I'm asking if they agree that the order contains that provision.
Could we rephrase to ask if they're aware whether it contains such a provision?
I'd be happy to. So are you aware that the partial consent order provides that UI must spend $30 million to comply with that consent order before seeking recovery or funding of costs above that amount from the state or any third party?
That's my understanding, correct.
Has UI spent $30 million towards complying with the partial consent order?
Not as today.
Are you aware that the partial consent order requires UI to maintain an accounting of all costs incurred or accrued regarding the consent order?
We do for our external spend.
So UI does maintain an accounting of costs incurred or accrued regarding the consent order?
Correct.
And has that accounting been provided to the Commissioner of Energy and Environmental Protection?
There is, on a monthly basis, in one of our reports, we do provide that information.
Has that information been accepted or approved by the department, to your knowledge?
I'm not aware that there's an approval on the monthly report that we submit.
How much has UI spent complying with the partial consent order?
Yeah, without looking back at what we discussed earlier before lunch, it was in the order of $16 million.
But an accounting of those expenses has not been approved or accepted by the department, to the best of your knowledge.
To the best of my knowledge, I'm not aware of that.
To the best of your knowledge, does the partial consent order have a deadline for achieving compliance with that order?
As part of the order, there was a target of 3 years.
And has UI met that deadline?
I'm going to object to the question. I think that calls for a legal conclusion relating to the interpretation of the partial consent order, the date the obligations became effective, and whether or not they've been met. So I think that requires a legal conclusion that the witness is not qualified to provide.
Are you aware that the partial consent order was executed in July of 2016?
2016, I was thinking August, but it could have been July.
Summer of 2016?
Yep.
Has UI completed the cleanup of the English Station property?
It has not yet to date.
Thank you. I have nothing further.
Thank you. Nothing further.
Thank you. Do you have any questions, Commissioner Karen? Okay, we'll turn to questions from the bench.
We were talking about closures earlier. What's the general lifespan of a closure? Happen to know? 10 years, 12 years,
I would
40
put
years?
on the order of 20 to 30.
20, 30. Thank you.
Technology changes may impact that.
Okay. So when you all were working on the outage mitigation program, and the question came up, I think, from Attorney Wheel, that you had done no real actual analysis of what it would take to eliminate the causes, as opposed to just reduce the length of outages. Is that correct?
When we say eliminate, so I mean, we have many programs in place to mitigate outages. We have aging infrastructure programs. We have vegetation.
I'm sorry, I should have clarified. For the worst performing circuits, as we were discussing earlier this morning.
So our historic approach has been to try to identify where the risk and exposure is and mitigate those elements. In general, to provide the significant improvement that we're seeing with the application of the automation, we believe it would cost significantly more to mitigate the outages along all of those circuits.
Right. So that's more of a generalization based on industry knowledge and career longevity, essentially, knowledge of the industry and the circuits themselves. Okay, thank you. Earlier during Mr. Pfaff's cross-examination, we were talking about model calculations, and it was mentioned there wasn't actually a model. It's just they're generally calculations that are done in the course of business of doing a rate case that go across utilities, jurisdictions. So they're just actually general calculations, but there may have been some Connecticut wrinkles that required something a little more specific in terms of developing those calculations. Did I get that right?
I think that's right. What I was describing is that we call it the plant model. It's an Excel spreadsheet that has a series of calculations in it, some of which are more standard for rate making and others of which are made to be specific to Connecticut jurisdiction.
So it's nothing new, untried, novel, nothing like that. Okay, thank you.
My name is Daniel Dane. Thanks.
And also we were talking sometime after that concerning some of the cyber transmission items that have been developed and for one purpose essentially, but then they were found that they actually were more actually allocated toward the transmission as opposed to the distribution system. So all those items have become used and useful. They're not projected. They're they're in the system essentially.
The items that were in rate base that were moved out were used and useful. Yes.
Okay, okay. That's it. That's all I have. I believe. Let me check one more thing. I think that's an old one. Yes, all set. Thank you.
Excuse me. Thank you. I have I have a foundational question about depreciation. I think that relates to leave file exhibit 1, but let me pose it this way. Mr. Hurwitz, I'm not sure if this is for you. Uh, what would cause depreciation to stop accruing? Sorry, missed the verge maybe.
So April DeBurge, sorry, forgot my name tag over there. So for UI, we basically have two types of assets, group assets and individual assets. So the group assets are homogenized, like poles, overhead lines, and the way that we apply depreciation to those is at the group. So they would stop depreciating if you were to get rid of the entire group. For example, if we sold us streetlights to all the municipalities and we no longer had streetlights, we would stop depreciating the streetlight asset class. We also have some accounts that are in the depreciation study, they're labeled as like amortization accounting, and those ones are generally individually depreciated. Things usually like software, vehicles, and so those would stop depreciating when they get to net book value 0, and we've recovered all of that investment. We would stop depreciating those individuals.
Thank you. So with the caveat that an asset would stop depreciating once it reaches net book value of 0, there's nothing else that would artificially cause depreciation to stop accruing during the pendency of a rate case up to the start of a rate year, correct?
Correct.
All right. Thank you. Those are my questions. So does the company need a moment for redirect? Okay.
Yes, if we could take a few moments.
Sure. We'll recess for a few minutes here.
We have just a few questions on redirect. Once our
Okay.
okay. Okay. Okay. First question I'm going to direct to Mr. Hurwitz. Mr. Hurwitz, do you recall some questions just prior to the break regarding what might cause depreciation to stop? And the Birds provided a response on that.
I do recall that.
And do you have any additional comments in that regarding that concept?
A couple. The Burge described the limited circumstances in which depreciation on the company's investments might stop. And the thing I would add is that the company's not going to stop investing in its system either. We're a regulated utility. Investing in our infrastructure is foundational to our business. And from a revenue requirement perspective, something that was very important to us is the matching principle. In other words, we hope to align all elements of the revenue requirement from a time period perspective. In other jurisdictions, this has also been called the test year principle. So for example, we want to make sure that all revenues and expenses in the test year are aligned, and we're similarly concerned with aligning accumulated depreciation in plant and service.
Thank you. Mr. Mullen, do you recall questions earlier today from Attorney Bidra and from the attorneys for Deep regarding English Station?
I do.
And specifically, do you recall that you were asked some questions regarding the company's obligations with respect to remediation at English Station?
I do.
And do you know whether the company's obligations in that regard are based on a partial consent order with Deep?
Yes.
Okay, and in your responses to those questions, did you intend to provide a legal analysis or interpretation of the requirements of the consent order?
I did not.
And in your responses, did you understand that the scope of the company's obligations are specified within the four corners of that document, being the partial consent order?
Yes, correct.
Okay, thank you. And in your position as Director of Environmental Remediation, am I correct that you're not an attorney or otherwise qualified or to provide a legal opinion on the scope of the partial consent order?
Correct.
And lastly, in your position, are you authorized to make binding commitments on behalf of the company with respect to remediation at English Station?
I am not.
Okay, thank you. That's all we have for redirect. Oh, and we also do have read in one that we can provide at the right time.
Okay, then if we want to do read in one immediately before this panel, so maybe we can change out witnesses for the O&M panel as you see fit, and
Sure.
We'll start with the read in.
Okay, thank you. Okay, so we gotta switch up the panel. Right? Okay, where's mine?
Yeah.
Yeah. Okay, so. All right. So while the other panel gets situated, Mr. Kulka is at the table and he can provide the response to read in one. Mr. Kulka, can you please provide that?
Yes. These are the relative rate of returns or rate of return indices for rate years 2 and rate year 3 to supplement what we filed in late file 5. So rate year 2 first, rate R, the relative rate of return becomes 0.17. Rate RT is 1.11. Rate GS is 1.66. GST 2.55, LPT 3.32, M 0.48, and U 1.50. So rate year 3, R 0.20, RT 1.14, GS 1.68, GST 2.47, LPT 3.14, M 0.35, and U is 1.18.
Thank you, Mr. Kulka. Okay.
Chairman Gillette, so in addition to the members who were previously sworn in, we have, I think, 6 witnesses on this panel who need to adopt their responses.
Okay, so everyone's sworn in? Okay.
Yes, everyone's been sworn.
Great.
Mr. Bieber, Ms. Van Luling, Mr. Jessup, Mr. Lavulo, Ms. Hagan, and Mr. Jerzak. As part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the evidentiary hearing in this case?
Yes.
And do you have any corrections to any of your late filed exhibit responses?
I do. Late filing exhibit 052. The second paragraph should be replaced by, as of December 31st, 2022, if the company wrote off non-hardship accounts receivable greater than 180 days, the company would have written off $16,593,547. And in the last paragraph of late filing exhibit 52, we need to strike the first two sentences and insert these two sentences. Non-hardship customers are subject to termination of service for non-payment starting at approximately 52 days past due. And absent payment or payment arrangements, write-offs can occur starting approximately 136 days past due date.
Thank you, Ms. Van Lulen. And then Mr. Labulo, I believe you mentioned that you had correction.
Yes, I do have one correction. This is for late filing exhibit 048. The table with the document descriptions, two descriptions were inadvertently switched in that table. Purchase order number 450558848 should read quote and sole source as documents description. And purchase order 45053588896 should read RFP contract successful bid.
Thank you, Mr. Labulo. And just to be clear for the record, that was referring to the supplemental response, correct?
That was the supplement to LFE 048.
Thank you.
The
And-
March 16th supplement, excuse me. I think there were two. No.
Two supplements to LFE. I believe there's only, yes, I believe it was the March 16th supplement to LFE 48, the response.
Okay, thank you.
And subject to those corrections, members of the panel, do you adopt your late file exhibit responses as part of your sworn testimony in this case?
Yes.
Yes.
Thank you. The witnesses are available for cross-examination.
Thank you. Very good. We'll begin with cross by the authority staff. Mr. Path, please.
Thank you, Madam Chair. And thank you all again for being available for questions. I have one line of cross-examination that I believe will mostly, if not entirely, be directed to Mr. Bieber. Is that how you pronounce it?
Yes.
Okay. I always like to make sure I'm pronouncing names correctly because mine practically never gets pronounced correctly. So I feel for everybody with quirky last names. Okay. I want to ask about LFE 45, and this was a question related to the changes in FERC accounts that we saw in another IR response, RRU 421. And specifically, it was related to a handful of FERC accounts, 190, 282, 283, and 254. Before we start talking about LFE 45 in detail, could you first start by describing what FERC account 190, what role that plays for the company, how it's utilized by the company?
So FERC account 190, like FERC account 282 and FERC account 283, they each represent deferred tax accounts. And so to the extent those were customer funded deferred taxes, in this case in account 190, they would relate to deductible differences. So typically you would find an asset in account 190. So those would just be assets that are typically reflected there.
And I'm going to run through all of these, but I think it's easiest to do it one at a time. How how would you describe how the company utilizes FERC account 282?
282 typically would reflect plant-related taxable temporary difference impacts.
And 283?
283 would typically represent taxable temporary difference impacts other than plant.
And 254?
254, to the extent it's tax related, would typically represent a regulatory liability associated with tax balances.
And the company complies with FERC guidance related to these FERC accounts, correct? That's the attempt.
Yeah, we attempt to be FERC compliant.
Gotcha. And I guess my question was if I looked at the FERC chart of account guidance and looked at the descriptions related to these accounts, the company is using that same methodology. It's not intentionally deviating from that methodology for any reason.
No, we wouldn't. We tend to we seek to agree with the accounting as prescribed by FERC with regard to those accounts. There may be some instances where there could be different interpretations of what truly represents a plant-related amount, though, and there could be other things where maybe there's an underlying pre-tax account that moves or changes in balance. So, for example, if a regulatory asset or an account that was typically a regulatory asset, so say an account 182, for example, or to have a negative balance, then that negative balance would be more like a 254 liability. So then you ask yourself the question, well, is that a reg liability that should have the deferred taxes in account 190, or should it be in account 283? So it starts off simple, but it can get a little bit complicated.
And the FERC account 190, so that's an asset account, and then the other three are liability accounts. Is that accurate?
The other three are liability accounts, two of which are deferred tax accounts.
Okay. In your response to LFE 45, you stated that the change from 2018 to 2019, other than normal annual activity, related primarily to two drivers. The first one you noted was a reclassification of the net TCJA DIT, which for everyone else's benefit, that's Tax Cuts and Jobs Act, deferred income tax, correct?
Yes.
So that's a reduction from account 282 to accounts 190, 282, and 283. Why was this reclassification necessary?
The original remeasurement, if you think back to the timing of when the law change came out, it was very late in the year. There were a lot of complexities around providing, and the estimate, as I recall, the accounting guidance allowed us to have a provisional estimate that we could subsequently adjust. And so our emphasis was on getting as accurate in a provisional estimate as possible. And we recorded the entire amount to account 282.
So the company recorded the entire amount to 282 and subsequently refined that to recategorize it to 190, 282, and 283.
That is correct.
Okay. Next one that you discuss, the next reason that you discuss is a reclass of the DTL. I believe that's for tax liability, but let me know if that's incorrect, related to the repairs deduction from account 283 to 282. Can you explain what drove the need for that reclass?
It was more to align with the as I recall, it was more to align with the presentation of the broader Avangrid group. We had initially reflected these amounts in account 283, and our auditors at the time didn't have a problem with the classification, and so we maintained it. And then subsequently, we again chose to reclass the balance to account 282. It's not a substantive difference in moving it.
When you say it's not a substantive difference, what do you mean by that?
I mean, the amounts are funded, benefits provided by customers, and the fact that we moved it from account 283, from 283 to 282 shouldn't have had an impact on rate making.
The next paragraph, you discuss the differences from 2019 to 2020. And you say that the individual balance changes from 2019 and 2020, other than normal annual activity, were primarily driven from an $89 million reclass between accounts 282 and 283. Then you go on to say that the reclass was driven by calculations done at the balance sheet level with regard to the prescribed accounting for accounts 190, 282, and 283. And the amounts within the subsidiary pages were aligned to that interpretation. When I initially read this, I interpreted this as this being on the parent level, and that's what the balance sheet level meant. But what did you mean when you said that they were primarily driven by calculations done at the balance sheet level?
Typically the preparation of the detail pages that support these accounts 190, 282, and 283 are prepared within the groups, well, in this case, with those pages within the tax group or those who support the tax function. In the case of the balance sheet, that happens at a higher level and not by the tax group. And so as the FERC Form 1 was being prepared and audited, it was concluded that it was appropriate at the balance sheet level to make some reclasses between accounts 190, 282, and 283. And so we conformed those subsidiary pages to be in alignment with what was determined during the course of the FERC audit, or the audit of the company's FERC Form 1.
So this change was driven by the auditors themselves?
I do not recall specifically if it was solely the auditors, but a combination of the company and the auditors. We concluded that we should make that it was concluded that the balance sheet was audited, and we conformed the pages to agree with the balance sheet.
Do you know why the change was made in the first place?
What I can tell you is I expect that in 2022, you will see a reversion to the way it was originally classified. Of course, we're not done with the 2022 FERC forms,
Mm-hmm.
but my expectation is that you will see a reversion to the presentation as reflected in the subsidiary pages.
And so if I understand you correctly, you were saying that the reclass that was done from 2019 to 2020 will essentially be reversed?
That's my expectation.
And I know, as you discussed earlier, this might not necessarily impact rate making if it's just a reclass, but as you also described earlier, you meaning the company seeks to conform with FERC account guidance when it comes to classifying these accounts. And I think we would both agree, and let me know if you disagree, but I think we both agree that these accounts are not interchangeable. So I guess I'm curious why your expectation is that this change that was made from 2019 to 2020 would be essentially reversed in subsequent years. Why is this not? I guess I'll ask it this way: why would this be such an ambiguous designation?
I don't know how to answer the question as to why it would be an ambiguous designation. I can tell you what I understand the FERC accounting rules to be. I can tell you what the tax group does in response to those things. And I can tell you what I expect the 2022 FERC form to reflect. But I cannot guarantee it. And I can only tell you that we seek to get the FERC classifications correct. And I believe the response that in LFE 45 reflects what happened with regard to 2019 versus 2020.
And so, but the tax group isn't the group within the company that actually designates these items to the FERC account?
Typically, there is alignment between the balance sheet and the subsidiary pages. In 2019 versus 2020, we mentioned a change that maintained that alignment. So, as I mentioned earlier, we as a tax team are the ones who would typically drive the classifications between these accounts. And in this particular instance, we were not. Such classification did not have, to the best of my knowledge, a substantive effect on anything concerning UI rate making.
And when you say a substantive effect, would it have any effect whatsoever, to the best of your knowledge?
I have no knowledge of any impact.
Okay. Also related to this paragraph, you state in your first sentence, you reference a reclass between accounts 282 and 283. And then your second sentence, you also mention accounts 190, account 190. Was that part of this reclassification?
You're in the first paragraph where we talk about.
I'm in the second paragraph.
Second paragraph. I just need a moment. I believe there may have been smaller reclasses with regard to account 190 as well.
Okay. And I know that you have described that there were reclassifications between these different accounts. It doesn't appear that the accounts have been quantified in terms of, for example, the first sentence that you had there and the first reason that you state that there was a large change between 2018 and 2019 was a reclassification of the net deferred taxes from account 282 to 190, 282 and 283. Would it be possible to have a read-in where the amounts of these reclassifications are quantified?
We may be able to do that. I think there's a high probability we can.
Okay, so we'll mark that as read-in 4.
And this would just be a quantification of the amounts referenced in LFE 45, in the response to LFE 45.
Thanks.
And with that, those are all my questions. Thank you.
Thank you, Mr. Path. Mr. Capozzi.
I do not have any questions. Thank you, Chairman.
Thank you, Mr. Bakari.
Good afternoon, Chairman, Commissioners, panel. Good afternoon. Sulama Bakr for Pura staff. Regarding the question that the chair asked earlier regarding accrual for depreciation, would the company continue to accrue depreciation on assets that are either retired or disposed of?
No, we would not.
Okay. Turn to your response to lead file 1, attachment 1, schedule B7.0.
We have that.
Okay, if you look at the unadjusted test year column and look at the items reported in row 7 or line 7, line 8, line 9, as well as line 16, actually line 17. Could you explain why the company is reducing the proposed edit for the text here by those amounts?
Sorry, could you say the last part again? Why the company is reducing ADIT for?
Those 4 items I just listed, subject to check, they're actually reducing the net edit. Is that correct?
Yeah, I might start by just generally describing something about the schedule. LFE 1, UI attachment 1, schedule B 7.0. The column labeled unadjusted test year is just that. It's the amount of ADIT in the unadjusted test year, subject to check as reflected in our initial filing. And then we discussed in a handful of data request responses and also at the previous set of hearings in this proceeding, some of the corrections we had to make related to ADIT, and we've reflected those in the pro forma test year column. So if you study the total accumulated deferred income tax liabilities presented on the schedule, the final line of numbers, you'll see that the pro forma value reflected here matches RRU 421.
Okay. If you go to line 7 for the pro forma test year, the 495 for injuries, could you explain where that tax asset is being reported for the test year?
Yep, one moment. Go to Schedule B 1.0, numbered line 29 is the reserve for injuries and damages.
Okay. Similarly, if you go to the next line item, vacation accrual.
Yep, one moment. Similarly, if you go to Schedule B 1.0, the corresponding amount is numbered line 32, accrued vacation.
Okay. The 772 for the test year, you adjusted that number upward by 77,000. Is that correct?
I'm sorry, which line?
This line 8.
Vacation accrual. Yes, I do see that.
Okay. If you go to your response to RIU 436 supplemental attachment, page 1. If on page 1, subject to check, if you look on row, actually line number 13 through 16, those amount are the same amount that the company reported in B 7.0 line.
My apologies, Mr. Bakari. I actually don't have that attachment on my computer. So just 1 second so I can review the.
Okay.
My apologies. Could you please repeat your question?
The 4 items I listed, which was line 7, line 8, line 9, and line 17 from B 7.0, these are the same amount on those lines. Is that correct? For the test year.
Lines 7, 8,
9,
9,
and 17.
And 17. Yes, they do appear to be the same.
Okay. Do you know if those amounts has been included in the company's FAS 190 account number that was used to calculate the net edit of 324?
I am not sure which specific FERC account these deferred tax balances are reflected in.
Okay. Could you go to page 72 of schedule H1.1, I believe schedule H1 0.1?
That's page 234 of the company's 2021 FERC Form 1.
Okay.
With the header footnote data.
On page 234 of that FF1, subject to check the same 149 that you reported on line 18. That was the same amount from RRU 436 that was used to calculate the net edit.
Yes, I think that's correct.
Okay. If you remain on that same page, line 7, other edit, and you look at the detail of that line on page 72. The second item in there is injuries and damages. Subject to check, that's the same 475,000. Is that correct? 495,000.
Yes, I see the 495,000 on page 72 of Schedule H 1.01.
Okay. Similarly, if you look at the amount for vacational crew, 771,894, I believe that's the same 772,000.
I see that.
Okay, so those components are already included in the $149,000.
Those components are already included in the.
Included in the 149 on page 71 of the FF1. And they are component of the 149 that was used to calculate.
Page 234 of the company's 2021 FERC Form 1,
Okay.
which in this case is Schedule H 1.01, page 72,
Okay.
provides the components of the other accumulated deferred income tax amount
Okay.
presented on page 71 of that same schedule.
Okay. And you can confirm if you look on page 1 of 436, RRE 436 attachment 1, on line 3, the edit account reported on that line 149,406,119. That's the same account. That's the same amount from page 71. Is that correct?
I gave away the attachment prematurely. Apologies. Your question was, is the figure $149,406,119 reflected on RRU 436 UI Attachment 1 supplement the same as the figure reflected on Schedule H 1.01, page 71?
Yes.
It is.
Okay. So my question to you is, if those items were already included in the first 190 account, why is the company including those as a line item again in B7.0A?
So I might refer to our attachment to RRU 421. Which lists on Excel lines 11 through 16 the ADIT balances were picked up off the FERC Form 1 for UI as a whole.
Okay.
They sum up to just over 531 million. We then exclude from that certain discrete amounts related to transmission, Gen Con, and RDR, which again are summarized in RRU 421. And after making those discrete adjustments, the total amount of rate-based credit for ADIT at UI distribution that we calculate is $324,484,191. Then if you go to LFE 1 Schedule B 7.0, that's the same as the total amount of ADIT credit in rate base that we're reflecting for the pro forma test year. So my apologies if I'm missing a nuance, but I don't think it's double counting these deferred tax balances.
If the number we just look at on page 72 of your 4.1 are already included in the 149, which is the first 190 deferred tax asset used to offset the calculation of the 324 that you have on line 16 of B7. So how could the company indicate those numbers are not double counted?
They're in the total
Okay.
of the 531. And then when we get to Schedule B 7.0, we're presenting how we get to that 324 in a different way. But the total is clear of 324,484,000 is, as I hope is clearly demonstrated in RRU 421, is clearly the total amount of accumulated deferred income taxes at the UI level, less those certain discrete items.
Okay. If you go back to page 1 of 436, attachment 1, the supplement, line 10. Can you define what the company meant by RDR? Edit was RDR.
I don't recall what RDR stands for. There's 4 small fuel cells, my recollection that the company has.
Yeah, I believe the acronym RDR stands for Regulated Distributed Resources.
Okay. And those are the other production plants in 341, 345 accounts. Is that correct?
That's correct. Yeah, I don't recall the specific FERC account numbers, but it's in the production FERC plant accounts.
Turn to lead 523, please.
I'm there.
Okay. If you go to the Excel row 19 for the production plant, other production plant, could you explain if the company has depreciation expenses related to those other production plant in 2021?
Your question is, do we have expenses related to this plant?
Depreciation expense related to the other production plant assets of 49,930,979.
I don't know specifically, but I imagine that there are some expenses related to these plants.
Would the company be able to confirm and the certainty whether there's any depreciation expense related to that particular asset class in 2021?
There certainly wouldn't be anything in the revenue requirement.
Okay. Do we know how much is the 2021 depreciation expense related to the other production plants?
What was the word you said before? Expense? Depreciation expense?
Depreciation expense related to the other production plant assets in 2021.
Do you mind if we confer for one moment?
Okay.
Ricard, your question was, how much depreciation expense did UI incur associated with these RDR projects?
Yes, with the other production plant asset in 2021, yes.
We don't have that at our fingertips, but we'd be happy to take that as a read-in.
Chairman, can we have a reading?
Very good. I think we're up to read in 5.
Please turn to response to lead 526 attachment 1, page 13, please.
LFE 26, attachment 1.
Yes. If you look at the table summarizing the company rates base,
We don't see an attachment 1 for 26. 1 second, sorry.
lead 526, attachment 1.
It's the most recent 10K.
Okay.
Oh,
Apologies, which page were you referring to within? that
Page 13.
13? Thank you for your patience. I'm there now.
Okay, if you look at the summary for the rate base, for UI distribution for 2022, I believe the company is reporting rate base of 1.253 billion. Is that correct?
I see that, yes.
Subject to check, that amount is roughly about $13 million more than the 1.240 billion reported for 2021. Is that correct?
That's correct.
Is there a reason why the rate base only goes up by 13 million in 2022 as compared to 2021?
The balance of rate base in any given year will be a function of a number of factors, including the company's plant investment, depreciation, changes in deferred income taxes, and the balance of regulatory assets and liabilities.
Has the company filed any exhibit that support the calculation of that rate base amount in this proceeding?
The 2022 rate base amount of 1.253 billion.
Yes.
We have not provided work papers supporting that amount. We've provided many work papers supporting the amount of rate base reflected in the revenue requirement.
Chairman, I would like the company to supplement this response, lead 526, to provide exhibit showing the calculations of the rate base, the 2022 rate base of 1.253 billion on page 13.
Okay. Attorney Venora, Attorney Vaughn, is there any clarification needed?
No, I think we understand.
Okay, thank you. And again, I'll revisit the due date for the supplements before we adjourn.
Please go to pages 67 and 91 through 94.
Said page 67 and
91 through 94.
Okay.
The financial report presented on that page, specifically page 67, as well as the financial statement on page 91 through 94, as the company provided UI information or data that were incorporated into the consolidated financial report on those pages in this proceeding?
This is this is Andrea. The financial information on page 67 includes the segmented information for Avangrid, including renewables, networks, and other. For the year ended December 31st, 2021, this would include the actuals for UI distribution, which have theoretically been included as for all of the test year. For the year ended December 31st, 2022, I do not believe we've provided the final UID income statements as of this time.
But UI information were included in the consolidated report for 2022, is that correct?
Sorry, say that again?
UI information were combined as part of the consolidated report presented in the 10K.
Yep. Good.
Can we have the same financial statement for portion of UI data that were incorporated into the consolidated report, or provide UI stand-only financial report for 2022 that were combined in the consolidated report on page 91 through 94 for 2022?
Sure, you're looking for the year ending December 31st, 2022 UI distribution financial information as consolidated into the 10K.
Into the 10Ks.
For just the income statement.
For both income statement and the balance sheet.
Okay. Yep.
Yes, page 91 through 94 is income statement and balance sheet. Okay.
Okay.
That could be a supplement to the earlier supplement or a separate supplement on its own.
Supplement to late file exhibit 26.
26, yes.
Okay.
Yes. This is we absolutely have UID income statement. The balance sheet might be combined with transmission and commons.
Can we bifurcate what portions of the balance sheet items are for transmission and what portions are for distribution or any other non-distribution assets or plant that are incorporated into the overall UI numbers? Is that something the company can do?
One moment. We should be able to.
Okay. Turn to page 77 of the same attachment, please. If you look at the table close to the end of that page, just for confirmation, do you know if the company has incorporated the two unsecured notes indicated for UI into its late file one? Specifically, if Schedule D 1.0 has been updated to incorporate the impact of these two unsecured notes?
One moment.
Okay.
Thank you.
Mr. Bakari, I'm reviewing Schedule D 3.0. I've got LFE 1 UI attachment 1 open, but it would be the same in our initial filing. Lines 25 and 26 are for these two notes.
My question is that the company incorporated the two unsecured notes on page 77 into is updated filing in late file 1 schedule D 1.0?
I think the short answer is yes.
Turn to page 79, please.
Sorry, where'd you go?
Mr. Bakayo, what was the reference, please?
Page 79, 79.
Thank you.
The company has a table for capital expenditure on the top of the page. For UI, you are reporting, I believe, in 2022, 226, 2021, 186, and 2020, 204. Could you explain why the capital expenditure declined in 2021 as compared to 2020?
This is going to include both distribution and transmission.
Actually, anticipate my next question, which is how much of those 3 years capital expenditures are related to transmissions?
We don't have that at our fingertips, but we can get it for a read-in.
Okay, so read-in 6 would be, I'm sorry, Mr. Bakari, what was that?
The capital expenditure on page 79 of Lil File 26.
Okay.
For those 3 years, what portion of those capital expenditure are related to transmissions?
Okay, thank you. Read-in 6.
I would just highlight, Mr. Bakari, that the 2021 information is part of our SFR schedule F7, total company amount at 186 million. And the standalone distribution on schedule F7 labeled as distribution only at 143.5 million. The difference between those two would be transmission. We can fill in the information for the other years as requested as well.
Yeah, for 2020 and 2022. Okay.
Yes.
Okay, thank you. Earlier you indicated that late 522 was updated. Has that been filed into the record of this proceeding?
My apologies. We indicated that LFE which was updated?
LFE 52.
Yes.
Okay.
It was updated. Sorry, what was the second part of your question? Has it been?
Been submitted to PURA?
No,
we just corrected that.
Will company be filing an updated supplement to that late file, to the record?
Sure. Yeah.
Late file 52, is that the, is
Yeah,
that?
That's
Okay.
the one I had read. They just want us to.
Okay, sure.
Okay, so it's just a refile of late file exhibit 52 with the corrections from this point. Okay, thank you.
Beginning in 2022, the company started accruing hardship account and writing off only those that are beyond 180 days past due. Is that correct?
Can you repeat that one more time?
My question was beginning in 2022, the company began writing off hardship receivables that are more than 180 days past due. Is that correct?
That's correct.
Okay. Did the company did any analysis regarding the non-hardship portion instead of writing them off beyond 136 days, writing them off similarly as you do for hardship accounts, and see what the impact would be on your write-off? Has any analysis been done for that?
Oh, we did not, and we did not because by the time they're written off, they've already been shut off for non-hardship accounts. So we take the assumption that once they're shut off, they're going to pay within the next couple of weeks to be turned back on. So regardless of how long you wait after the shut off to write them off, it's not necessarily going to impact the collections.
But if you don't write off account until their 180 days past due, the write-up amount will be less than what you're currently doing. Is that correct?
No, that's not correct, because that would assume that they made a payment. Because they were shut off, their final billed before they're written off. So they're final billed and then shut off. And then there's a period of time between when they're final billed and shut off to when they're written off.
Okay.
And just to clarify on that, for the 180 days, for the active hardships, they're still making payments. So there's still customers actually making payments versus for the non-hardships, they've been shut off because they haven't made a payment.
Turn to LFE 54, please.
I have it.
The SS edit balances listed here. Could you explain if those were part of the items that are being refunded or to be refunded as part of the settlement in 210104?
Well, to be clear about what we're depicting here, what we are calling, when we use the word balances here, we're talking about activity associated with balances, not balances themselves. And within the response, we cite the testimony where the overall balances are reflected.
So let me just be clear. The amount referenced or classified as SS edit, whether they are protected or unprotected, those are not the same amount that the company is refunding as part of the settlement in 210104. Is that correct?
These are the amounts reflected in the settlement because those are the only amounts that we've been authorized to amortize at this point.
So the amount reported here as SS edit are the amount being refunded due to that settlement agreement?
I'm sorry, I didn't hear the first
The
part.
amount being reclassified here as SS edit, those amount represent the amount that the company proposed to refund or being of refunding to customer due to the settlement in 210104.
The amounts shown here on the first 4 lines represent access aided activity associated with the settlement agreement.
Okay, thank you. The post remeasurement savings of 8.293. Could you explain how the company derived that number?
That amortization is consistent with the settlement that you referred to.
Okay. The last item on that listing, the reclass of First 109. Could you explain why the company is reclassifying things from account liability from 254 to 182?
The company decided to present this amount on a net basis. It made that decision. It did not have a substantive effect on the unfunded deferred taxes, net reg asset.
You're classifying something that is liability refundable to customer, and you're classifying it to 182, which is a asset account, and you're saying that does not have impact on customer. Made that you're actually reducing the amount refundable to customer by that reclassification.
I disagree. We have a net reg asset, and we still have a net reg asset.
Okay. Could you go to the schedule reference, the page, and identify the line item that showed that reclassification?
Can I go to
page 232 of FF1.
Yes. Give me a moment. Okay, I have the page.
Could you identify the items that make up the 23 million that's being reclassified from 254 into this account?
I believe it's embedded within the line 2 line item of 16,030,820.
Okay. Okay. I'll turn to LFE 56 attachment 1, please.
LFE 56.
Actually change that 57 attachment 1. Sorry.
I have that.
Okay. If you look on line 10, the company is using wage allocator. Can you explain why the company is using wage allocator to allocate property or return on property related to the facility at Marsh Hill Road?
Yeah, as we've described previously, we use the wage allocator to allocate general and intangible property between UI's distribution and transmission operations with, there are a couple of exceptions to that, but generally that's the allocator that we used. And so that's why we've reflected the wage allocator here.
Those two properties, 100 and 180 Marsh Hill, those are considered planned for distribution. Is that correct?
Well, it's a building.
Okay.
Two buildings actually, but
and your company choose to use wage allocator to allocate portion related to transmission.
yeah, as a general matter, property book to the general FERC plant accounts is allocated using the wage allocator with one or two exceptions.
Okay. But for property tax allocation on line 15, the company is using the plant allocator. Is that correct?
Yes, UI's property taxes are allocated between transmission and distribution, generally using the plant allocator.
Okay. Line 23, could you explain why the company is still using 1.36? I believe that has been updated to 0.90.
That is fair. That has been updated.
Regarding the rental income that the company received from its affiliated companies, has UI ever considered using the ratio of the square footage actually occupied by those buildings and apply those ratio to their revenue requirements for those buildings in determining the rent of payment due from those affiliates?
We have, what's reflected in this revenue requirement is in terms of the rent credit to UI for space occupied by affiliates. It is the rent credit first set in UI's 2013 rate case and then reflected again in the 2016 rate case as grown by the 1.3 0.75% escalation rate, which produces rent credit per square foot rate today in the high 30s. And I think it gets into the low 40s by the rate years. And we felt since that's been approved by the authority in two separate rate cases, that was a reasonable basis for revenue requirement purposes.
Okay. That would be in 130119 and 060604.
Yeah, 160604, that's correct.
And this is a completely different proceeding from those, right? And the authority could direct the company to change some of the assumption for rental income. Is that correct?
This is a different proceeding. Okay. I'm not a lawyer, but I understand these are separate proceedings.
Okay. Do you know what percentage of the building at 180 Marsh Hill is occupied by Avangrid Service Company?
One moment. Thank you for your patience.
That's fine.
As reflected in footnotes 6 and 7 of Schedule C 3.01 WP, our analysis indicates that the service company occupies 26,136 square feet at 100 Marsh Hill Road and 72,729 square feet at 180 Marsh Hill Road. For context, the total square footage of those buildings is 181,443 square feet at 100 and 127,310 square feet at 180.
Chairman Gillette, that's all I have.
Thank you, Mr. Bakari. I believe that's it for authority staff.
Chair
Mr.
Gillette,
Birch.
we do actually have read-in 5,
Okay.
which came up during Mr. Bakari's cross, so.
Very good.
And this related to depreciation amounts in late file 23.
Mhm.
So April Savarsh. So the question was in 2021, the amount of depreciation expense on the production plant, the 3-4 series account codes, 2,741,210.72 cents.
Okay, thank you.
All right, thank you. Let's move to,
Sorry, Chairman Gillette, I believe Ms. Van Luling might have read in 6.
very good.
I have read-in 6, which was to quantify the amount of UIT versus UID CapEx in the 10K. So for 2022, UIT CapEx was 90,224,000. UID was 136,039,000. Kevin Donnelly previously provided 2021, and then 2020, UIT was 66,246,000, and UID was 138,181,000.
Okay, thank you.
You're welcome.
Thank you. Okay. All right, very good. We can transition to cross by the OCC, please.
Hello, Tom Wheel for the Office of Consumer Counsel. We're going to start with some questions from Rich Sobolewski.
Good afternoon, Chair Gillette. Good afternoon, Commissioner Karen. Members of the panel. Rich Sobolewski, I'm the supervisor of technical analysis for the OCC. I just have a few questions on late file 60, the supplement. I know there was some discussion earlier today with deep staff and staff of the AG. If we look at the attachment to late file 60 supplement, and I know there was some discussion with Attorney Bidra about the years 2021 and 2022, where certain items were not charged to the reserve, but they were charged to some operating expenses. It appears that those items were charged to account 582. Looking at my old uniform systems of accounts here, that's station expenses. Is that correct?
I do recall the discussion with Attorney Bidra. I don't recall what for account 582 relates to.
Okay. But it is an above the line account, is that correct?
It's one of the accounts included in O&M.
Okay. I know there was a discussion with Deep about the 2000 docket 000405, which was the sale of English Station.
I recall that as well.
I know the attorney read you a quote about the department's decision about the treating of expenses other than the bulkhead costs.
I recall that.
Okay. How is this the accounting that it's referenced here, where it was charged to an operating expense? How is that consistent with that decision?
I'll start and then invite my co-panelist, or if Ms. Mandaloon can proceed.
So we were instructed that shareholders should fund English station expenses up to the $30 million. And so we have not, when we incurred these expenses, they've run through the O&M line item, and they've therefore decreased net income. We have not recorded them as a regulatory asset. We are not seeking recovery of them. So they've decreased UI distributions net income, which was a direct impact to shareholders because we had less earnings per share and they've earned less on their investments.
Why weren't they charged to a below the line account rather than an O&M expense account?
Sure, we followed GAAP accounting for that, where these particular expenses are classified as O&M.
Regardless of what the Pura's prior order was?
The order was that shareholders should fund the expense up to the $30 million, and shareholders have funded that expense because we're not seeking regulatory recovery of these. We don't have them as a reg asset.
So is it the company's position that because there was not a rate case order that allowed you an expense, that in between rate cases, if you charge an item to an above the line account, that's acceptable?
Sorry, can you repeat that question?
Is it the company's position that because there was no specific decision that allowed these expenses in rates, that it was okay to charge them above the line?
So we followed the GAAP accounting. These types of expenses are considered O&M expenses, and they did impact net income. We're not seeking recovery of them. So they've reduced what should be the earnings for UI distribution that directly impacts shareholders.
instead of picking a different uniform system, a different account number that was a below the line number?
We followed the correct FERC accounting for them, which would, there are O&M line items.
Even though there was a decision from Pura that said that ratepayers shouldn't be paying for the expenses for English Station?
And ratepayers are not paying for the expenses of English Station because we're not seeking, ratepayers would be paying if we had hung them up in a reg asset and we're asking recovery of that reg asset, and we are not. So that amount was not in the revenue requirement. That amount is not being sought for recovery from ratepayers. That amount was borne by shareholders.
Since it did impact your earned rate of return, is it correct that it could have impacted your earnings sharing?
When you say that, since it did impact your allowed rate of return, can you clarify exactly what you're looking at?
Well, in your results for 2000 and I guess it's in 21 and 22, these did impact, like you said, your net income. Is that correct?
Yep, they impacted our net
So
income.
it would have impacted your earned return. Is that correct?
If you're asking if we made a regulatory adjustment to adjust them out,
Obviously you didn't. Is that correct?
that's correct, we did not.
That's all I have.
That's all I have. Thank you.
Thank you, Mr. Sobolewski. Mr. Attorney Wheel?
Thank you. I just have a couple of questions. My first question is about late file 46. The first question I have on this, so this references the response to EOE 94 UI attachment 2. I pulled that up and I couldn't find this quote in that response on the page that's indicated here on page 27. I was looking at the redacted version. So I guess can the company confirm that the language that's quoted in this response is in the redacted portion of the publicly filed version of EOE 94 attachment 2? Page. Sure, if you look at the publicly filed version of EOE 94 attachment 2, page 27. The response to LFE 46 is quoting that page, but the publicly filed version of that page does not have this language on it. Is that correct?
The publicly filed version should be the same, just with the redaction of the competitive bid amount.
Okay, but it isn't. Is that, I mean, are you looking at what the publicly filed version?
Just give me a moment.
Sure.
I'm not sure that I have that redacted version in front of me.
Okay.
Attorney Wheel, I do have it, and I can pass my computer over to Mr. Lavulo. I believe what we did here is that it is under page 27, subsection 1.1 is the beginning of that quote that says for single purchases. The redacted version initially provided in EOE 94 took out that redacted that sentence and at the request of the authority, we provided it, redacting only the dollar figure that was discussed in that sentence.
Okay, I think I was probably just not looking at the corrected version of that. Thanks. I was just trying to clarify for the record where this is. So my question is, it seems looking at the reference language in EOE 94 UI attachment 2, it looks to me like this is the standard that's applicable for when a requesting organization, which in this circumstance would be UI, needs authorization from Avangrid. Is that correct for a single purchase?
For a single purchase, the purchasing procedure references when a purchase needs to be competitively bid.
Yeah, but I'm not seeing it says here for single purchases of redacted amount, the requesting organization is solely responsible for purchasing the requirement and is responsible for issuing an order. I didn't see anything else on that page that referenced competitive bidding. It looked like the context was when Avangrid, like when the requesting organization needs higher level authorization. Is that not correct?
Below that amount, it does not need a competitive bid. Above that amount, it does need a competitive bid.
Can you?
Thanks. The following sections indicate delegated purchases and centralized purchases.
Okay, but where does it talk about specifically competitive bidding?
The description of delegated purchases and centralized purchases.
Okay, but that section isn't quoted anywhere in this response to LFE 46, right?
Attorney Wheeler, LFE 46 was just to provide that dollar figure that has been redacted over which a competitive bid would be required. And I believe that the redacted sections that Mr. Lavulo outlined on delegated purchases and centralized purchases may contain that information that the unredacted sentences at the beginning of those paragraphs may contain that information.
Thanks. So maybe I'm just trying to make this clearer for the record. Is it the case that that purchases over the redacted amount, that the standard is that those purchases must be subject to a competitive bid?
Yes, typically yes.
What do you mean by typically?
That there can be exceptions.
And who determines
sole
those?
source is required.
Okay.
So the requesting organization submits a sole source form that is reviewed within the requesting organization as well as within purchasing. And purchasing will either approve or deny that sole source request.
And where is purchasing? Like what level of the organization is purchasing in?
Purchasing is at the Avangrid service company level.
Okay. So in practice, if we're talking about UI seeking to make a purchase exceeding the redacted amount, they submit a request to purchasing at Avangrid, right?
Correct.
Okay. And the purchasing department at Avangrid can determine whether a competitive bid is required?
A competitive bid is always required unless the justification justifies that it cannot be competitively bid.
Okay, so it's always required, but not always.
It's always required except for sole source situations, which might be an upgrade of a system. It might be just making up Microsoft licenses, things that can't be competitively bid.
Okay. And does purchasing use is there a published standard for determining when sole sourcing is allowed?
There are justifications on the sole source form itself.
Okay. Has a sole source form been filed in this rate case?
Just while Mr. Lavulo looks for that, I just wanted to be clear for the record that I see Jack Jessup's name tag is up, but that is Peter Lavulo, just so we have clarity on that.
Thank you.
I do not recall if the sole source form was submitted in the final submittal.
Okay, thank you. My next question is about LFE 66. And depending on this, I might get the answers I need from the subsequent panel, which could be good for everybody. So the question is just about the inflation adjustment standard. So according to this response, the standard as set forth in a previous PURA finding is essentially that any cost that isn't a known and measurable change from the test year can be subject to the inflation adjustment. Is that accurate?
So this response described our application of inflation in the revenue requirement. And for that portion of the response, we were saying that it was consistent with PURA's previous finding that, quote, the authority typically allows utilities to apply a general inflation factor to operation and maintenance expenses not specifically adjusted elsewhere.
Yeah,
I was going to say that's generally consistent with practice in other jurisdictions about what might be called residual O&M, so O&M expenses that aren't explicitly adjusted, but the recognition that the company's costs are subject to inflationary pressures.
Okay. So the standard then is that if it's not an identified known and measurable change to the test year, then the inflation adjustment is applied?
Generally, and I would, with the caveat that a known and measurable adjustment can be no adjustment.
Okay. So that leads me to my next question, which pertains to LFE 89, which was provided by a different panel. But I'm going to try asking it here, right? Because if I can get an answer from you guys, then I won't have the question for that panel. It pertains to the weather subscription costs. And based on my rudimentary and unskilled math, it looks to me like these numbers on LFE 89 are generated from the inflation adjustment mechanism. Is that accurate?
Yes, I think that's accurate.
Okay. And this is the question that perhaps Mr. Eves has, since he's joined us, might be able to answer this. Does the company know that the weather subscription cost is going to change within the rate year? Within the rate years, that is.
We did not specifically study this cost, but it, I think, falls in the sort of general bucket Mr. Dane was just discussing.
Okay. So does that mean that it's not known or measurable whether this subscription is going to expire before the rate years are over?
I'm not sure that's what I said.
Okay, but is that what it means?
No.
But, well, the general bucket Mr. Dane described, what I heard was that any cost that isn't known or where there isn't a known or measurable change, including whether it's known and measurable that there is no change, that's the standard for applying the inflation adjustment. So I see the inflation adjustment's been applied to this cost, which according to my understanding based on Mr. Dane's testimony means that the company does not know whether this subscription is going to be constant over the rate years. Is that correct?
Mr. Attorney Will, could you just break that down? Like when you ask if is that correct, because you gave a speech regarding your understanding of the legal standard.
Sure.
Maybe we could break that down.
Well, it's not a legal standard, Attorney Venora. It's the standard that Mr. Dane just testified about regarding what mechanisms, what triggers the inflation adjustment mechanism. My question was, is it the case that the company has no idea whether this subscription cost is going to change over the rate years?
I'm going to offer a clarification and then defer on that your question, but I would just offer the clarification that an inflation adjustment is known and measurable. It's just not a specific known and measurable adjustment to a specific cost.
Okay.
And could you, sorry, Mr. Wheel, but if you could repeat the question.
Is it the case that the company has no idea, does not know one way or the other whether this subscription that's referenced in LFE 89 is going to change over the rate years?
I don't think that was our testimony. I think our testimony was that we have not specifically studied this, and we've in the sort of general, we've included it in the general category of inflation. I was just recalling as you were asking that question, the approach taken by the Massachusetts Department of Public Utilities, which strictly adheres to a known and measurable standard, applies an inflationary adjustment very similar to the one that we've developed here. So I was just caught up in the way you were asking the question, but
yeah, I'm still just not, I still feel like I'm not hearing an answer to my question, which is the answer that the company doesn't know whether this subscription cost is going to change between now and the end of rate year 3?
This specific service is from an individual that provides meteorology services. So there is an expectation that those costs will appreciate relative to inflation, but we don't have a contractual commitment that would occur at this point.
Okay, thank you. So last question on this, following right up on what Mr. Eves just mentioned, if there is a contractual commitment for a given cost, and that contractual commitment, I mean, if there's a contract or any kind of contractual agreement that does demonstrate that a cost will stay constant or will change, that would be something that isn't subject to the inflation adjustment. Is that accurate?
That's a broad statement, and I'd want to consider the specifics of each expense. But generally, if we had a contract that specified changes, we would consider those for reflection in the revenue requirement.
Okay. What would, I'm still just, I'm confused about this standard then, because what circumstances, if you had a contract for an expense that lasted across all 3 rate years, so there was that would make it a known and measurable expense, under what circumstances, like what circumstances would trigger your analysis to apply the inflation adjustment to that?
As I described, the inflation adjustment is applied to residual expenses that aren't specifically considered or adjusted otherwise. So for the expense we're talking about here, it's $10,000 in a revenue requirement with O&M. That's probably about $100,000. So it's a very small percentage. Oh, sorry, 100 million, excuse me. So we have to consider that residual bucket, and our position is that there may be some expenses that grow at greater than inflation, some that less, but overall that's a reasonable indicator of the expected escalation in that residual category.
Okay, thank you. I just had just a couple last questions following up on Attorney Sobolewski's line of questioning. Just so I understand, Ms. Van Luling, you were saying that the costs, the above the line costs associated with English Station, those aren't being charged to ratepayers because the company is not seeking recovery of them in a regulatory asset and because they weren't specifically in the regulatory requirement in the last rate case. Is that correct?
Correct.
Okay.
And they've negatively impacted net income, which has negatively impacted earnings per share, which is shareholder funds.
Okay. Isn't that the case with any expense the company incurs that isn't allowed within the revenue requirement in the last rate case or being booked to a reg asset?
Yes.
Thank you. No further questions.
Thank you. I think we are going to break until 3:15, at which time we will resume cross for this panel and by EOE. Okay. Thank you.
Thank you. It's really good.
Didn't get too far.
I mean, you can plug in here if you want. There's a bunch of plug-in right here. But still got some battery. Okay. Nice. You know, 7 years old. But it didn't help that Right, right. I thought about it. Bill said, I told you, I got your song. He said, oh, you're not my love. Right. Yeah. Yeah. I didn't realize it was you either. How's it going? Yeah, this is better food. Yes. It's only been those 2 so many years. Yeah. They don't allow us to get out of the office. That's what it is. Good shit. You going after us? No, I think they usually. Oh, well, after you, yes. And then after us. I will see you.
You've already snagged a pop.
Yeah, so.
I'm sorry. I'm sorry. It's like.
Sorry, you might like whispering it short. Sorry. I see the same
Thank you, appreciate it. Okay.
Okay, any administrative matters before we begin?
Just one, Chair Gillette, on read-in number 4, which Mr. Bakari requested relating to late file 45. In order to give him all the information we think is probably useful to him, we're wondering if that could be converted to do a supplement to late file 45.
Understood.
Okay.
Thank you.
All right, then we can resume cross by EOE, please.
Thank you, Chair. Good afternoon, panel. Chris Parent from EOE staff. I just have questions on two topics, two of the late files that were remitted. The first one I'll refer you to is late file number 63.
Hi, Jack.
Sure.
Well, I could-
My first question is I was looking to obtain a general overview as to what was provided. The original request was to compare and contrast two different exhibits, and I just would like a better understanding of what this actually represents.
It represents the costs and the reimbursements for the storm
Okay.
activity that we've seen in the past several years.
Okay, so just then to clarify a little bit more, so for each mutual aid event from 2017 through present, with an event that occurred in 16 and had some activity in 17, this is the costs broken out by category? I guess that's my first question.
Correct.
And then the revenue amount is the offsetting, I'll call it fully loaded costs that you recovered?
Correct. The reimbursement from the utility that we supported.
Okay. Can you just clarify the reimbursement amount that you guys, that the company received? How were the actual costs derived? Were these the straight up costs, or were they inclusive of overtime and other?
Mike Jurzak, they're total costs.
So that means
inclusive of overtime.
It would be.
Yes.
If I recall in the hearing, there was a reference to 17% connected with vehicle usage. Do you recall that discussion during the hearing? 7%.
It's about 7%.
7%.
Yep.
That clarifies my next question. Thank you.
The 17 was high level estimate, subject to check. So looking back at it, it was 7%. Yeah, and that is per FTE. So per crew would be 14%.
So if I was to run the math on the fleet line items compared to the labor, should it be around 7 or 14? And I know it's an estimate. I'm just trying to make sure that I understand what's been provided.
Yeah, 14%.
Okay. As part of the response, there were a handful of items where the net mutual aid was above 20,000, and there was a reference that you were planning to recover that. And then any amounts below 20,000, you were not, if I'm characterizing that. Can you just expand upon that?
Sure. So if I can just address how we do the billing.
Sure.
So it's a point in time billing. So cost update along the way. And we make a balance basically of determining does it make sense to go back and have a true up for something that's might be $2,000 difference one way or the other. So we just have a tentative threshold of $20,000 that makes it worthwhile for both companies sending and receiving to make sure that true up occurs.
Okay. My last question on this specific exhibit is, this does include several of the amounts that differ from the other two exhibits. Can you just explain that? I just want to make sure this is the final exhibit that would identify mutual aid. And does that mean that the other exhibits are?
Can you just clarify the other exhibits?
So in the original cross, we had referenced RRU 252. And EOE 203 attachment 1. So for example, EOE 203 attachment 1 it has distribution mutual aid amounts from 2017-19, a very small number. Whereas when I review the LFE 63, there seems to be quite a few more.
There are. So in 2017 to, I'd say, midway or partially through 2019, a lot of the mutual aid costs were being filtered up through the balance sheet.
Okay.
And what you see in 203 is just what's included in O&M. So that's the largest difference. Why you see more storms, more mutual aid events in LFE 63 versus 203.
Okay. Thank you. The next topic is late file exhibit number 92.
I have that.
Great, thank you. Does your response to late file 92 state that there's no cloud-based software assets on UI's books?
It does state that.
Can the company clarify what it means by its response to the company's investment in the municipal portal was recorded to FERC account 365?
What sort of clarification would you be seeking?
I guess my first question is, what is FERC 365?
Overhead lines.
So overhead conductors and devices,
Yes.
Can you explain how the municipal okay, I'm going to use the word portal or hub synonymously there. I've read that all throughout. I'm not sure which ones you guys would prefer I can use.
I understand the question.
How is that related to overhead lines?
Right. So the cloud computing accounting guidance is a little bit complicated. And so generally our IT folks are the ones that would be managing those types of agreements, would be familiar with sort of the unique processing that we have for running those through our accounting system. So in this particular instance, the folks in operations were the ones that initiated this purchase. We have a questionnaire that goes along with the process where it's looking for the justification if we have control of the asset or not in order to determine if it's capitalizable. So they did fill out the questionnaire according to the terms and conditions of the contract, and it did qualify as a cloud computing asset. However, after that, they completed a purchase requisition with a work order for overhead lines, as opposed to we use what we refer to as the SAP real estate module to handle these types of contracts. So since this question was brought up, I've reached out to the requisitioner, had a conversation about the process for these cloud computing arrangements and getting this rectified. And then also just kind of reinforcing the process moving forward and trying to reach out to more of our requisitioners outside of the IT scope, since it seems that this is, a new concept, but permeating into other areas of operations. So we need to make sure that folks have the right tool set to be able to get them to the right accounting. So
I'll apologize because I'm just trying to interpret what you just said. So does that mean that it was booked incorrectly?
Yes.
And FERC account 365, what is the period in which it was being capitalized?
So depreciated for 40
Sorry,
years.
thank you.
Yes.
Amortized if it was treated correctly.
Yes. Yeah. So not capitalized, right? So it becomes plant and service. I believe it was in 2021, perhaps 2022. I'd have to look back at it, but it was placed into service. So then it began depreciating with a rate equivalent to about 40 years, I believe. And it should be an amortization account. We talked about this a little bit earlier with the individual assets, which for a cloud computing arrangement would be according to the contractual terms and conditions. So,
And the contractual terms and conditions, if I have it right from the original hearing, was 3 years?
I believe that is the case. Yes. Still, again, under review to get that reclassified.
Sure.
We did discuss this impact and we did not make an adjustment in the revenue requirement for that. Given the 3-year rate plan, it will be additional depreciation expense, but we conservatively did not make an adjustment for that.
So just to clarify for my sake, I think I was quoting 875,000 during the hearing, but it was actually 825,000. Am I correct? Subject to check. I think I was quoting it wrong. I just want to.
Yes, 825.
Okay. And what was the first year that the 825 would have been applicable?
We've been developing it over the last couple of years, but this year so in 22, there were costs associated, and then moving forward with the full application supporting all the municipalities, it would be 825.
Okay, so I'm sorry, so the first 825 would be as of what year? I guess when was the asset added to FERC account 365? What, I guess, year and month?
Bear with me one moment.
No worries.
So it was 2022 that it went into plant and service in account 365.
Do you know the month?
December.
December. Were there any costs associated with the development of the municipal hub beyond just the subscription cost of 825,000?
Yes.
And the amounts were?
Just a snapshot in time. That's not necessarily everything.
That's life to date as of the other day when I moved this. So this is 21. This is 22.
So for the lifetime of the project, it's 1.876 million. And we began with a pilot program with the town of Fairfield to investigate the capabilities, develop the requirements. And then we moved on to working with the other municipalities to incorporate those, and went live at the end of 22 with all the municipalities.
So just so I'm clear, the 1.8769 that I heard you say, does that include any of the subscriptions, or that is?
Total inclusive of the project.
So that's subscription for 3 full years plus any development efforts. I apologize if the math isn't working. We could do a write-in if you want to confirm. I don't mean to be putting you on the spot.
A supplement or a read-in?
I'm fine with either one.
And I'm sorry, you're looking for the cost to date and the remaining costs across the rate years?
Correct.
Okay. So the cost as of,
When it was added into service, which would be December of '22, if I heard you correctly.
yes,
And its impact on the remaining rate years,
We can-
meaning any additional costs that would be tied in.
we supplement, you know, LFE.
It'd probably be late file 92 if you were going to supplement.
We'll provide a supplement to LFE 92 for that.
Great. My last question on this, I just want to make sure that I'm on the same page with how the accounting is going to be handled. It would be my understanding, apologize if I word this wrong, I am an accountant. It would be my understanding that you would take the full subscription cost, put it up as an asset, and take any of the amounts that have not yet been paid and put it up as a liability. Is that how you guys would understand this to be, where the net would actually?
Right. So I need to review the full contract, but yes, if there are payments that are required in order to reach the full term, so if we're contractually obligated to make those 3 payments, then yes, we would accrue for the total value of the contract at inception and then depreciate or amortize over the 3 years.
Okay.
And then also where it's cloud computing, you have to look at the components of the contract. If there's a hosting service or something else that would go to O&M and not be capitalized.
Along with any potential internally developed expenses. So
if it qualifies as a capitalized asset, internal development can also be capitalized in that term generally. Implementation costs.
So when you quoted the unusual amount, I assume there was some internal development tied in. The 1.87.
There is, yes.
Okay.
Sorry, yes. That is what we have recorded in our plant accounts as of the end of 2022. What we need to investigate is the additional contractual payments that would get us to the 3-year term, which is what we'll supplement. I don't have the contract, so I'm not able to do that here, but.
So then the supplement to the late file 92 would be the total contractual amount plus the breakdown of any costs that were used in development. And it'll also explain how this will be moved to the correct account and then amortized from there. So it's just kind of tying it together. So wrapping up back to the response to late file 92 then, there are no other cloud software assets that UI, it says there are none on your books, but are there any others that should be on your books that were treated incorrectly?
Not that I'm aware of. There are other cloud computing arrangements, but they tend to be at the organizational level. So we do have some at the service company, for example, which are applications that are utilized against or across all of our networks affiliates. That's what we tend to, which are the ones that are managed by our IT folks. So I think there's some Microsoft arrangements. There's Primavera, which we heard reference to in Mr. O'Loughlin's testimony about the tool that we use to do the gate checking of the capitalization. So there are some, but they are just not directly on the books of UI distribution. They're at the service companies.
Okay, so you're comfortable that this response is accurate for any other cloud-based software that could?
As far as I know, yes.
Great, that's all I have. Thank you. Oh, sorry.
I just want to clarify. Mr. Parent articulated exactly what he wants in the supplement to LFE 92, and you understand it. Everyone does.
All of the costs, all of the development costs, the contractual costs, how it will be amortized, how it will move between plant accounts, like the full suite of accounting for.
Yes, thank you.
Accountant to accountant.
All right, thank you. Attorney Bidra.
Good afternoon. Lauren Bidra, Office of the Attorney General. Very briefly, in reviewing the late file exhibits, I have a question about the application. Did the company request recovery of directors and officers' liability insurance in this proceeding?
One moment. I think we answered a data request on this. I'm just going to dig that up.
Thank you.
As we described in response to OCC 19, UI did not incur and was not allocated any directors and officers insurance expense in the test year and is therefore not seeking recovery of any D&O insurance expense in the rate years.
Thank you. That's all I have.
Thank you, Attorney Vidra. Attorney Marshall? Please.
Good afternoon to the panel. I just have one question for Mr. Mullen. Is he still here? Hi, Mr. Mullen.
Good afternoon.
During evidentiary hearings, the company provided a read-in response, that is read-in W, regarding the East Shore facility and whether the costs related to the East Shore remediation were included in the prior rate case or in a prior settlement. Do you recall providing a response to that read-in?
I do.
And there you stated, Mr. Mullen, regarding the East Shore remediation, that the costs specific to the East Shore site have not been identified in the previous rate case or settlement. My question is simply, can you clarify what the company means by the costs have not been identified?
Yeah, in preparation of our estimate provided in the testimony, I was unable to find where the company had requested any funding for that project before.
And by saying you were unable to find it, I'm just looking for a simple yes or no. Since you were unable to find it, would the answer be no? The costs were not included?
Correct.
Thank you. That's all, Chairman.
Thank you, Attorney Marshall. Okay, questions from the bench?
I'm here.
All right, thank you. I just have a couple. And I just want to, Mr. Hurwitz, following up on Attorney Bidra, make sure I understood the response correctly. So it sounds like the D&O insurance, there is no direct allocation. I just want to triple check my understanding. So that means that the company's testimony is there's no indirect allocation through the corporate service charge or anything else as well.
That's correct.
Okay, thank you. Okay, so my remaining questions are about LFE 66 and attachment 1. I want to pick up on the line of cross that you're having earlier on inflationary adjustments. So let me start by asking, my recollection from testimony during the evidentiary hearings was that the company has not or does not go back and study how projections from prior rate cases reconcile against actuals when it comes to inflation. And I just want to make sure that that is an accurate recollection of the company's testimony. And Ms. Van Luling, I think it was a conversation we were having, but I could be mistaken.
That's consistent with my recollection.
Okay, thank you, Mr. Hurwitz. Okay, so if I'm looking at LFE 66 attachment 1, page 2, I just want to make sure I'm understanding what I'm looking at. You've broken down the O&M expenses. You've itemized them. These are actuals or projections?
These are rate year 1, which is a projected rate year.
I'm sorry, I'm on page 2, for it's labeled 160604 test year pro forma. And then columns D through H are 2017 through 2021.
I apologize. Sure, those are actuals.
Okay, so although the company has not studied it, theoretically, it could go compare the data that's shown in page 2 of the late file exhibit to what was projected in 160604 and compare actuals to projections. Am I missing something?
No, I don't think so. And we did some of that in the written response, comparing that data to historical inflation over the period.
Okay, so because I think what I'm struggling with is I don't really see any category, like if I'm looking at line items, when I go by the Excel row, so Excel row 18 downward, with the exception of the outside services storm reserve, which remains constant. First glance, I don't see any category that has a demonstrable trend upward or downward from the 2016 through 2021. They kind of are all over the place. So I guess what I'm asking is, has the company reconciled the lack of a, well, I guess the lack of a trend is a trend of in of itself, but have you reconciled the fact that there's no consistent increase in these expenses compared to what was submitted in the 2016 rate case and perhaps requested for an inflationary adjustment in that case?
And I see where you're struggling, and I agree that on a line item by line item perspective, that's difficult to do because items can change. We described in this hearing the corporate capital charge, for instance, and so there may be some differences like that over time, which is why in putting together this response, we looked at the O&M expenses on a total basis because that mutes the impact of any one change up or down and provides an overall reflection of the escalation in the company's costs.
Okay, thank you. So line item by line item though, which of the categories shown in the late file exhibit did the company go out to your vendors and ask on a prospective basis whether those vendors had known and measurable expected changes over the 3 rate years, if any?
Madam Chairman, I would say we didn't go out and canvass all of our outside contractors to understand, which will specifically reflect a cost of living adjustment or an inflation adjustment or something to that effect. There are a handful of discrete contractor adjustments that we've reflected in the revenue requirement, and those are footnoted throughout our schedules where we've made an adjustment like that. But we did not do a survey along the lines of what you just suggested.
I appreciate that, Mr. Harris. And I think I understood that in response to earlier questions. So I think what I'm struggling with is how to understand is how the company decided to whom to to seek that information from? Because you clearly did it with a few, but you didn't do it line item by line item.
I would say generally, while preparing the revenue requirement, we met with as many areas of the business as possible to identify discrete adjustments to reflect. And in instances where we had something specific, we reflected that in the revenue requirement. Does that answer your question?
I think so. So when you say you met with areas of the business, is that only internal? So you didn't survey any external, or is captured in those meetings those parts of the business who interact with external? But I lost you there.
The last thing you described, there may be one or two of the people that we talked with were technically external to the company, but by and large, it was with employees of the company or its affiliates who interact on a regular basis with our outside contractors.
Okay. And in any of those meetings, did anyone tell you that they are not expecting to be subject to inflationary pressures? Or did anybody say that?
Many people were concerned that inflation would understate our needs, and in instances where they could link that to a document demonstrating that inflation would be insufficient, we've reflected a known and measurable adjustment or a pro forma adjustment to the revenue requirement. But in instances where they just sort of expressed a vague concern, we went with the inflation adjustment.
Okay. Okay. But you're not let me just circle back around. Okay, so there are how many line items here? There's 27 line items associated with O&M expenses, if I'm reading this correctly. You didn't specifically target through these conversations requests about each line item.
That's a fair characterization. Generally, the people we met with might have insight into one element of one line item, or in other instances, something that might affect multiple line items, but our review was not schedule by schedule.
Okay. Okay. I appreciate that, Mr. Hurwitz. Let me just make sure I've got. I guess the last question. So when you did encounter areas of the business who had concrete materials that suggested that they were going to be subject to inflationary pressures, what were those concrete materials? Were they like actual estimates from vendors, or?
As I was describing that, I was thinking of two specific examples in the revenue requirement. One was related to customer service. And in just one moment, I'll pull up the specific reference for you. It's on schedule WPC 3.10, where they had a demonstrable increase in the call taking vendor costs. And then another example is we have a contract with Landis and Gear for our monthly meter reading fee. And those are two instances where the business came back with a concrete contracted cost increase that we reflected in the revenue requirement.
Okay. Okay. Thank you, Mr. Hurwitz. Those are my questions. Attorney Venora, do you need a moment to consider redirect?
Yes, if we could.
Okay, thank you.
Thank you. The company does not have any redirect for this panel.
All right, thank you, Attorney Venora. And we can thank this panel and excuse them. And that means we're moving into our employee compensation panel.
Madam Chair, maybe while
Oh, I'm so sorry. I can't quite hear you.
sorry, I was going to offer while the transition was happening, but didn't realize you couldn't hear me. I was just going to let the authority know that I don't have cross anymore for the operations and efficiencies and cost savings panel, and I don't believe the Attorney General does either, and we're the only parties that reserve. So I just wanted to put that out there for everybody's
Okay,
convenience.
very good. I appreciate that. Attorney Bidra, anything further? That's
Attorney General's office waives cross for that panel just for planning purposes for the witnesses.
Thank you. Thank you. Attorney Venora, then in that case, if there's anyone on that panel that needs to adopt plate files, I'm happy to do that right now. And
Is he joint or with somebody? We're just checking. I think Mr. Cole might have been the only one, but I believe he might have been joint with one of the other witnesses.
Okay.
Mr. Eves, we're checking that right now.
All right.
Thank
you.
Yeah, we just checked. Mr. Cole was a witness on one late filed exhibit, but it was joint with Mr. Eves, and Mr. Eves adopted all of the late filed exhibits. So I believe for purposes of the record, it's in the record. So,
Okay, very
um,
good.
and otherwise, everyone else has already been sworn. So.
All right, excellent.
What's-
Six hours.
Chair Gillette, just to clarify, so are we authorized, can we release that panel?
Yes.
Okay, thank you.
Yes. That panel being the
Yeah, that panel
page
being
6.
operational efficiencies and cost savings, page 6.
Yes,
correct.
thank you.
Thank you.
Okay, thank you. Go ahead.
I was gonna say, I believe the panel is all present. Everyone was previously sworn in, Chairman Gillette, and we have 5 panel members who just need to adopt their late file exhibits.
Okay, please proceed.
Ms. Allman, Mr. Visconti, Mr. O'Neill, Mr. Canavan, and Mr. Tremble. As part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of evidentiary hearings in this case?
Yes.
Yes. And do you have any corrections to any of your late filed exhibit responses?
No.
And do you adopt your late file exhibit responses as part of your sworn testimony in this case?
Yes.
Thank you. The panel is available for cross-examination.
Very good, thank you. Mr. Vacalina?
Good afternoon, Jim Vacalina, Authority staff. If you could turn to late file exhibit 78, please. Just a couple of questions here. Year 2018, it mentions people move from UI to UIL of 110 employees. Does UIL provide services to entities other than UI?
Yes, it does. It provides services to our gas companies as well. in
Okay.
Connecticut.
Would it also Berkshire? Would it?
Yes.
Okay. The second bullet in 2018, people move UI to Avangrid Services Company or ASC 26. Now, ASC would provide services to even more entities. Would that be correct? Than UIL?
That is correct.
Okay. Now, when you mention up in the response above the table here, actual leveraging the transmission allocation factor, what does that exactly mean?
I'll allow Mr. Hurwitz to
Okay.
respond to the
We were just noting that the text of the request sought us to use the 82.28 transmission allocation factor.
I see. Thank you. Late file 79, please. And I'll look at the bottom table here, which is distribution only FTEs. The first column here, 12/31/21, this is the company's test year. And it's the company set at 519 employees, correct?
Yes, for the
UI
distribution.
Distribution.
Yes.
Yes. Yeah. And I understand we've had the discussion about you don't actually have transmission employees, it's an allocation, essentially 8218 or thereabouts.
That's correct.
Okay. So we're looking at distribution only here, understood. The 519, the 11 underneath that would have been employees that, I guess we're not part of the increment that you're looking to incorporate in this rate case, but were other vacancies within distribution?
I would describe that as open positions and active recruitment.
Open positions, okay. And if I take the head count across here for each column, FTEs at application and 22823, it looks like we're down to 485 as of the latest employee count. Is that correct?
You said a number in the middle there that I didn't see.
Yeah, FTEs at application, the middle column there, 498.
Yes, 498. I do see that.
And up to the latest, you're at 485.
I see that as well.
Okay. And the vacant and hiring has also increased. You have now, as of 228, the existing positions that you have gone from 11 to 36. Correct? Okay. So I am understanding this correctly.
Just to clarify, existing positions again is the open positions and active recruitment.
Yes.
Just to be clear. But
okay.
I think you got it.
And the 78 ties back to more of the incremental FTEs that you were looking at adding as a result of this rate case.
That's right. The 78 is linked to the 95 in the table above, which is the new incremental positions requested as part of this proceeding.
Okay. Thank you.
There was a table in the direct testimony of the revenue requirements panel itemizing that amount.
Okay. I thought that was the case. I just wanted to make sure I had that right. Late file exhibit 80, please. Attachment 1.
I am there.
Okay. And this asked for essentially the transmission allocation factor or the distribution allocation factor, which the remainder is transmission. And it's gone from 7% transmission to 17.72% for year one.
I do see that.
Okay.
Well, I see the inverse technically, but
yeah,
I see what you're saying.
Okay. Would it be fair to say that, first of all, the transmission revenue requirements, if you're able to answer this question, is that an annual revenue requirement?
It is.
Okay. And that would take into account, O&M things, including payroll, labor, et cetera. Is that correct?
It would.
Okay.
There are a lot of nuanced rules about how that works that I couldn't describe in detail, but at a high level, yes,
Okay.
that's correct.
So as the time of the rate case, you would have had 7% employees dedicated to transmission, the rest dedicated to distribution. And as the years have gone along here and you filed transmission rate cases, the number of transmission employees have increased. Therefore, that would have increased the transmission revenue requirement during the course of these years.
I think that's right. I would just reiterate the caveat you acknowledged a few minutes ago about we don't have dedicated transmission or dedicated transmission employees, but in concept, yes, I agree.
Okay. Using understanding that, one person is not a transmission employee, but using these percentages. Okay.
That's right.
All right. Thank you. Late file 73, please. This is more of a clarifying. I'm on attachment 1. And if I add up the total charges here, I come up with approximately $46 million. Subject to check, unless you'd like to add that. But and I'm looking at the asterisk here, which says the difference between WPC 3.27, this late file, is primarily due to overheads that are capitalized at UI, but are shown as charges out in the schedule above. So WPC 3.27, this is the expense portion of the corporate service charge. I'm looking at rate year one of $41 million. So doing that simple math between 46 and 41 here, $5 million is capitalized overheads. Is that a correct assumption?
The late file exhibit 73, attachment 1 does not include the transmission credit. That's in the work paper that you just referenced. 3.27, I believe.
Okay. And it looks like the transmission credit goes away after the test year. Is that correct? I don't see that in rate year one.
I wouldn't say that it goes away.
Okay.
Rather, I'm looking at Schedule WPC 3.27, and I'm focusing on the pro forma adjustment column. And what we did was we, in effect, redistributed that credit across the functions.
I see.
I have LFE 1 up, so that column totals something that's not 29,000, but because of some corrections we made in LFE 1. But in our initial filing, the sum total of that pro forma adjustment column was very, very small, simply because we were redistributing the transmission allocation credit.
That was due to a misallocation to distribution from transmission. I was going to say generated costs, but I think you know what I mean, right?
I think I do.
Okay.
I don't know if I would describe it as a misallocation. I don't know that would be wrong. Rather, there are a variety of costs allocated between UI transmission and UI distribution during the test year based on one wage allocator or one allocator, the wage allocator, and then in December we made a true up adjustment to reflect the more appropriate Massachusetts formula.
I see. I stand corrected. It was not it was more of a Massachusetts formula identification of different levels that should have been allocated.
That's right.
Okay. So that being said, there's been a lot of talk about the service charge decreasing from previous rate cases. What would, and understanding that this is an expense portion here, what is the full cost when we take into consideration the capitalized amounts like those we see in this, the asterisk here? Do we have that? Sure.
Let's see.
Bless you.
Are you seeking the total amount of costs from UIL to UI in 2021?
Well, this would be, my understanding, this is all service company charges here. What we're looking at 3.27. So, and this is the expense portion. What I would like to know is what the total amount of charges are, including those that show up in other areas as being capitalized on the books of UI from the three service companies.
One moment. Mr. Bacalina, I would refer you to the company's response to EOE 135. And we recycled chunks of that response in answers to subsequent data request responses. But as described therein, and as Ms. Van Luling described at the previous set of hearings, corporate service charges are generally allocated to UI in a cascade fashion, meaning AMC charges to ASC, ASC charges to UIL, and then UIL charges to UI. There are some limited exceptions to that, but as a general matter, that's how it works. And EOE 135 UI attachment 2 provides the total amount charged from UIL to UI. And the number at the bottom of page 1 of that attachment is 61,256,334.
Okay.
And that's to UI as a whole. And then a subsequent attachment to that response illustrates how that figure becomes UI distribution expense.
Okay. Okay, thank you. Those are all the questions I have.
All right. Thank you, Mr. Buckley. I believe Attorney Bidra has waived cross.
Nothing here.
Thank you. I don't have any questions for this panel. So Attorney Venor, do you need a moment to consider redirect?
I think we're all set. We don't have any redirect for this panel.
All right, thank you. In that case, this panel is excused. Thank you.
Thank you.
We're gonna move to page 7 of the agenda. EOE will be up first for cross. So we're at the customer experience fee-free program low income rate panel.
Oh, Fraser and Leona. Yeah. I gotta say that. Tell her that we have one here.
Yeah, it's
Stuffy.
one that was on the quarter page this time.
Yeah, right.
Chair Gillette, I had reported to the case coordinator. We were not sure of Mr. Patterson's status. He's not available to be here today, but we do have 2 additional witnesses who were previously sworn, Ms. Leona Michelson and Mr. Fraser McBride, who work closely with him and can cover any questions that come up relating to his late filed exhibits.
Right, understood. Thank you.
Thank you.
And Attorney White, Attorney Wyman, I don't know that we're gonna do your full 90 minutes this evening. Okay. We will likely stop after EOE's cross, even if it's before 5:15, so.
I believe everyone's situated. And Chairman Gillette, I believe all of the witnesses on this panel were sworn in previously, and we'll just have a few adopt their late filed exhibits. Ms. Palella, Mr. Drahota, and Mr. Daniels, as part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the evidentiary hearing in this case?
Yes, I did.
Yes.
And do you have any corrections to any of your late filed exhibit responses?
I do not.
I do not.
And one.
Okay. Could you explain that correction, Mr. Adrilla?
Yeah, so EOE, I believe, or LFE 96, in my answer, I referred to attachment 1. I meant to put in attachment 2. So I'm not sure if you had.
So that's late file exhibit 96, where it refers to EOE 5 attachment 1.
Yes,
You're saying it
EOE
should
5.
be EOE 5 attachment 2, correct?
Yes, correct.
Thank you. And subject to that correction, do you adopt your late file exhibit responses as part of your sworn testimony in this case?
I do.
And Ms. Palella and Mr. Daniels, same question.
I do.
Thank you. Mr. McBride and Ms. Michelson, as part of your preparation for this hearing, did you review late file exhibit responses sponsored or co-sponsored by Mr. Patterson?
Yes.
Yes, I did.
And do you have any corrections to any of those late file exhibit responses?
No.
No, I do not.
And do you adopt your late file exhibit responses as part of your testimony in this case?
Yes.
Yes, I do.
Thank you. The panel's available for cross.
Very good. Thank you. Attorney White, please. I'm sorry, Mr. Auger.
Hi, good afternoon, Frank Augeri, Pure EOE staff. If we could start with LFE 94, please. Am I correct to assume that based on this response, the company would have room to add, please call UI at 800-722-5584 as soon as possible in that first bill message area on page 1?
Yes.
Okay, thank you. LFE 95, please. Looking at attachment 1. On the attachment, the screenshot appears to show 3 other tabs: service summary, usage detail, and usage charges. The attachment didn't include what is on those tabs. Could you describe what the customer would see when they access any one of those 3?
Yeah, so that would be, obviously a summary of their uses on the service summary. It's relatively intuitive to the tab name, but the usage detail in terms of further detail into their usage, and then also the charges on the charges tab.
So that usage detail, does it state the line items that the customer would also see on their bills?
I can check on that momentarily.
Would the actual line items appear on any one of these 3 tabs? Or is that something you need to check?
We need to check on that.
Okay. Why don't we move on while you're checking? So when the CSR is using the bill analyzer, are they seeing the same information that the customer is seeing from this My Account application?
They would have access to the same information, correct?
So there's nothing more that the CSR is seeing than the customer is seeing through the My Account application.
Subject to tech, no.
Does the bill analyzer tool explain to a customer why there's been an increase in usage?
Can you provide further detail by what you mean by that?
Customer calls you to complain about a high bill and says, there's no way I used 1,000 kilowatt hours this month. Does the bill analyzer explain the increase?
The bill analyzer itself would not explain what caused that increase. Again, the CSR would ask some investigatory questions about the customer's usage in order to drill down into what could have caused that. They'll be provided through the bill analyzer tool directional data to show usage on a particular day of week, or where they might be able to say, on this day, I see that your usage increased by 10 kilowatt hours. Was there something that you were doing in that particular day? Did you install any new devices that might be drawing electricity? But it wouldn't point to a definitive reason by using the tool to say what specifically caused that increase.
So the bill analyzer is more or less to provide insight into possible explanations.
Exactly. It's directional.
Does the application, the My Account application, is that also its purpose, is to provide insight towards possible explanations or insight into possible?
Yes, and in the energy analyzer tool, it does have a breakdown of the things that you have, or the devices within your house that comprise your electricity usage generally. So it'll talk about like dishwasher versus lighting, those sorts of things. So again, in order to understand exactly what's driving the usage, you have to dig into and ask exploratory questions about what are you doing on a day-to-day basis that could be driving consumption.
So in EOE 41, which is the basis for late file exhibit 95, do you happen to have attachment 1 to EOE 41 handy? Looking specifically at page 12 of attachment 1.
What was the page reference?
Page 12 of attachment 1.
We're there.
Okay. Now I know the screen grab on this page is for a gas customer, but let's assume we're looking at it as an electric customer. Does that CSR have the ability to look at months over previous years, say January 23, January 2022, January 2021 at the same time?
Yeah, so they do have, they can do side-by-side comparisons on your usage same time last year.
Okay. Can they do it over a time period of certain months, 3 months, 4 months, 6 months?
Yes.
Okay. Is that functionality also in the My Account bill history application?
Yes, actually, I'm looking at My Account right now, and the first thing that pops up on the Energy Analyzer tool is a usage comparison, which compares March of 2022 usage versus March of 2023 usage.
I'm sorry, Mr. Daniels, can you make sure the mic is on? Thank you. Thank you.
One last set of questions on this bill analyzer and My Account bill history. Does the bill analyzer, I think I asked you that question. I don't know if you were able to check on it. Does it show the line items?
Let's take a look. I'm actually in there right now. So there's a daily consumption chart, which shows consumption for a period of time by day. And your question was specific to line items?
Yeah, specific to a line item. So let's start with the bill analyzer that the UI rep has. Does it show the individual line items and what was charged during that billing period.
Yeah, so the usage charges tab gives a breakdown of the generation charges for a particular billing cycle, delivery charges, basic service charge, other charges, and then the total current charges.
Okay, and that's the My Account application, correct?
Correct.
Okay, so when it gives you the breakdown for distribution, I believe you said,
Yes.
does it then break down all those distribution charges? Distribution service charge per kilowatt hour, everything that would comprise the distribution total.
I'm not seeing that level of detail.
Is that level of detail in the bill analyzer tool that the UI customer service rep has?
I'm unsure. I know that many representatives often would pull up the monthly bill itself to break down that level of detail to a customer. And that's generally the route that they would take. They'd pull up a copy of their bill and break down those charges for them.
Right. So you'd agree that individual line items can change from year to year, correct?
Yes, absolutely.
Do you think it would help if while you were comparing months over previous years to have the ability to look at individual line item rates might be helpful?
I agree that that could be helpful, yes.
Okay. Do you think it would be helpful if it was in the My Account application as well too?
I think any data that we can give a customer to understand what's driving the cost of their service, I think that would be helpful.
How much? Strike that question. That's all I have. Thank you.
We have more there.
Thank you.
Please refer to LFE 108.
Got it.
Okay. So in the response, you refer to outbound column D, and you said there were hours charged at a rate of $25.95 through August of 22 and $35.95 starting in September 22. Is that amount to be charged in a contract you have with ICOR?
It is not explicitly in the contract. So that was what we agreed upon.
Agreed upon how then? Like, where's the document in which you agreed upon it?
The documentation.
Right.
Yeah, I'd have to look for it.
It's not associated with the contract?
So prices can change in the contract and there's frameworks. So I would have to go back and look at that. I imagine we have it in the framework, which I don't have with me right now. And that's what we call when we redo pricing with a vendor. So I believe I do have it. Just need to check that.
So I'm sorry, did you want
Is the framework somewhere in the docket to the best of your knowledge?
I don't believe so.
Okay, thank you.
Is there a reason you didn't provide it in response to ROU 181 with the contract?
One second.
Attorney White, what reference was that to?
The original reference was to LFE 108 and the prices that are included in LFE 108. And I was trying to inquire if I didn't see those numbers in the contract, and that was why I was trying to understand where those numbers came from.
Thank you.
Actually, let me help this a little bit along. Can you provide as a supplement to RRU 181 all of the rate, whatever you did to supplement that contract with ICOR?
Yes.
Because actually, I have a feeling this impacts pretty much every question I was about to ask down through here, because the next one was going to be in LFE 108, you mentioned a charge of 11 cents per contact. Is that in some sort of other document that you have?
Possibly, yes. That's not a standard service that ICOR or a third-party vendor does for us. It was a 2-month deal during those 2 months, and I apologize, I'm struggling on my computer here. So that was just a 2-month deal that specific to UI that we asked them to help us with that.
Right, but do you have a contract? How do you come up with a charge if you don't have a contract?
Right. Yeah, so I'll need to search for that.
Okay, so that was a supplement to LFE. It was at 108.
Yes, we could call it a supplement to LFE 108.
Okay, is the company clear on what EOE is looking for?
So to be clear, any supplemental, because we do have amendments, we do have addendums and things like that, anything supplemental to that contract?
Right, yeah. RRU 181 that the authority posed to you, I believe asked you for your contract with ICOR. It sounds like, according to what I'm hearing, that you didn't provide the complete contract in response to RRU 181, or at least you didn't provide all the supplements that go along with the contract. So I want everything that shows me all of the rates that are supported in LFE 108.
Okay.
I just want to make sure we're clear. That includes the framework you were.
Correct.
Okay, thank you.
So I have a feeling it also applies to LFE 98 too, because I was going to ask you a similar question about LFE 98. You referred to compliance penalties of $200. I equally don't see that in the contract in the record.
That should be in the MSA under compliance penalties. There's going to be a table where if they have between 1 and 31, which can accumulate over the year, phone calls that are directly related to a regulatory complaint, they'll get a $200 charge. If they exceed that, it's kind of a step penalty. So that one should be in the MSA.
So by MSA, do you mean RRU 181 attachment 3?
Yeah, I'm trying to get in there.
Master service agreement, that's.
Right. Yeah, and I do believe it. I'm sorry, I can't pull it up. I'm still trying to pull it up, but
Yeah, hold on. Hold on.
so you were referencing a specific page?
Well, my question was referencing the $200, and you said you thought it was in the MSA. I'm looking at RRU 181 attachment 3, and I'm on page 21. Is that what you're referring to?
Let me get to it.
I would just note that the question RRU 181 asks specific documents related to ICOR that were identified
board of directors. And there's a minute. So it's possible that the contract we're referring to now is not referenced in 181. We'll have to get it to the supplement.
Okay. There was a contract provided in 181. As long as I have a complete copy of that contract with all of the supplements involved, I'm
Yeah, we'll work towards that.
Okay, so, that, I'm sorry, I'm not sure which late files that we're supplementing. I had 108, but
we're not. I believe Attorney Canavan was clarifying the other supplement, or we didn't add a new one at the moment. I don't believe.
okay, so it's just the supplement to 108, or was it 181? I got.
I think they should probably. We are ultimately looking for a supplement to RRU 181. RRU 181 provided the contract with ICOR. That was what the authority, my understanding, I could be incorrect of what the authority requested. That was what I thought was provided, and it appears that we might not have the complete document. So I'm, and the LFE 108 referenced payments being made that I don't see in the document in the record. So I'm trying to make sure we have the complete document in the record.
Okay, so is that, thank you, Attorney White. Is that clear to the company?
Yeah, it is clear. I think the company did provide the complete document. I think what Mr. Drahota is talking about is some supplemental, potentially supplemental amendments after the fact. So, but we understand, I think, what is being requested, and we're indifferent whether we provide it as a supplement to RRU 181 or to the late filed exhibit 108.
Okay.
So,
I would just also like to clarify, the supplemental have the dates when it was entered, right?
I'm sorry, say that again.
The supplements to the contract, they'll have the dates. It'll show when they began.
I would
correct?
assume so.
Okay, thank you. I want to make sure we have that information as well.
Yeah.
Okay, so I believe our current question, if all of that is clear, I don't want to leave something. So I believe my current question was actually regarding the $200 compliance penalty, and Mr. Drahota had referenced a chart 1 to 30 and 200 in that, and I think maybe that chart is in RRU 181 on page 19. Is that the chart you're referring to? Yes. Oh, I'm sorry, page 21. My mistake. Okay, that chart on page 21 of that document seems to apply to a different operating company, and if you look immediately below that chart, it specifically says that once compliance stepped penalties for other op companies, other than the op company that's there, will be mutually agreed in writing and signed by both parties. So I don't believe that chart applies to UI. Do you have the chart that applies to UI somewhere?
Well, what I need is that's the chart we're using for UI. And so I am aware of that contract language in there and need something in writing to show you that we've agreed to it for all of our opcos.
Correct. Is that going to be provided in the supplements that you're providing?
Yeah, and I'm going to search for it. So you will get it if I have it.
Okay, thank you. I'm sorry to jump around, but we were on a theme there, so I stuck with it. I'm going to go back briefly to late file 108, but in the response you mentioned up training and new hire training. Who conducts up training?
The vendor.
Okay. Who conducts new hire training?
The vendor.
Okay. And going back to that same thing, the training is in the contract that you have with ICOR, and it will be supplemented. Yes. And okay. Have you executed a new contract with ICOR?
Not yet.
Have you executed a new contract with Alorica?
Yes, as of Friday.
That, I assume then if it was as of Friday, that's not in the record?
No.
Could we get that in the record?
Sure.
Could we request that, please, Chairman? It could be a supplement to the other. It could be included in the other supplement that we're having, since they're supplementing the contract with ICOR, they could provide the contract with Lorica as well. That way we would have both customer service vendor contracts in one place.
Sure, as a supplement to LFE 108.
Sure.
That is.
Actually, I only have a couple more questions. Please refer to LFE 99. And actually, I can ask the question probably without you pulling it up. The materials that you provided there, it provided 3 attachments. Those are the most updated documents that the CSRs currently have.
Those are the most updated training documents, correct?
Okay. One final question. Please refer to LFE 106. This one you might need to look at. So the late file request, it requested an explanation of the increase between years 2019 and 2020. If I read it correctly, I think your explanation was that there were approximately 50,000 accounts that rolled over, so to speak, from one year to the other. But I'm having a little bit of trouble understanding how that explains the entire increase. So if you could just help me a little bit. Basically, from my perspective, I see that you did approximately 89,000. You charged approximately 89,000 customers interest in 2019. So that's at a rate of about, and I'm rounding here, 7,400-ish a month. Whereas in 2.5 months, even if we take out the 50,000 that rolled over, so to speak, you charged 63,000 customers in 2.5 months versus 89 the entire year before. So I'm having trouble understanding how the 50,000 rolling over explains what we were looking for in the LFE.
Yeah, I don't know that we were able to explain specifically. I mean, those accounts were assessed those late payment charges because they had late payments. We did, just try to look at the specifics of the accounts to see if it continued to be the same accounts that were experiencing a late payment charge from one year into the next, and that's why we added that character and the additional information. I agree with you, it doesn't necessarily explain, but the fact is we pulled the report and that's what the report showed, and we were able to identify that the commonality was that 50,000 accounts.
When you pulled the report, did you notice a monthly increase? Did 2019 have an increase toward the end of the year? Do you have the monthly report there?
We're going to check and see what level of detail that we have available.
Okay. If you have a monthly breakdown, it might be easier if we just provide that as a supplement to LFE 106, rather than explaining it all in a read-in.
Yeah, that's fine.
Okay. And could we request that, please?
Okay. Supplement to LFE 106.
A monthly breakdown of the number of customers interest charges from in 2019 and 2020, but 2020 was only 2.5 months. EOEs.
That's it.
Across.
Okay, thank you. I know, so we're gonna stop it. I just wanna do one staff member from Pura, and then I think we'll wrap for the evening. So if I can call up Attorney Solares. Solares.
Thank you, Chairman, Commissioner. Good afternoon. My name is Sarah Solars. I'm a staff attorney with Pura, and my cross will focus on late file exhibit 110 and the accompanying attachment. My first question, I'm curious, we asked for in late file exhibit 110 the amount of the fee-free program proposed if only residential customers were included in the program. But it appears as if the program proposal costs have increased from what was originally filed in the application, also different from the amounts filed in a response to an interrogatory. So I was curious if you could explain what the difference or specifically the increase in the cost relates to.
So it was a decrease. So we had I believe the original that was in the pre-file testimony was updated, and we included customers for ACH payments. And so that brought the totals to what's in that reply, the late file reply. So if you see the 1777, for example, for year one, 1.7. And then when we did residential only, that reduced it to 1.6 million.
Yes, I see that. The numbers I was looking at originally in pre-filed testimony on page 30, there's a set of numbers provided for the rate years 1, 2, and 3. It looked like those numbers were reduced in RRU 455. And if it's helpful, I can show them on the screen. But I was curious if the change is that there's an inclusion now of the ACH payment. Is that what the change is?
That's according to my records, yes. The original that was in the pre-filed testimony was increased because of we neglected to include the ACH. So when we included the ACH, that's what's in the late file that you see there that compares the previous charges, which were higher, and then the residential only.
Okay.
Which is lower.
Okay. And in addition, in late file 110, attachment 1, there's the line for each of the years for a payment aggregator block of $5,000 each month. Can you explain what that is?
I can check on that detail.
Okay. And that
payment aggregator block.
Yes. Thank you. So to be clear, the final proposal for the fee-free program, the cost is what is in late file exhibit 110.
The cost for residential?
Yes.
Yes.
And then in the actual narrative, though, there is a different number for the cost of residential and commercial. So that is what's being proposed.
In the pre-file testimony?
I'm sorry, I'm referring to late file exhibit 110. There's the initial narrative response, which provides the program proposal, including commercial and residential. And then you also include just residential.
Right.
And all of those numbers are different from what was originally filed in the application. I just want to clarify this is
correct.
Okay.
Yes.
Okay, I'm sorry, Ms. Below, on the detail for the payment aggregator block, do you need that as a read-in?
Yeah, we'll do a read-in.
Okay, that will be read-in. Seven? Great, thank you.
And the fee associated with the ACH payments, it looks like on attachment to LFE 110, on the very bottom, there's a chart that shows the average cost per transaction, and there's varying numbers starting at $4.18 for 2019. Are those in reference to the ACH payments?
Attachment 2?
The attachment to
attachment
110, yeah.
Can you repeat the question?
Yes, so on the very bottom of the attachment, there's it's not actually in a table, but there are a list of numbers starting at $4.18 in 2019 and then through 2022. And are those the payment processing amounts for the ACH?
I'll double check that as well. I can do that as a read-in as well.
Okay. So that would be read-in 8, Chairman.
Correct.
Thank you.
And those are and just to clarify, the column B, line 7980, that section right there.
My printout doesn't identify it like that, but
yes. Average cost per transaction.
yes, exact. Thank you.
Thank you.
So how, as a follow-up to that, how does the company determine what the fee is for the ACH processing payment?
So the fee that was used for this proposal was the fee that we're currently charging customers, which is the $395 and the $650 for commercial.
And is this a fee that I understand that will the fee be negotiated in a contract somewhere?
Yes. Yes. So that RFP is I believe we're due to issue it this month. I was subject to check. I don't believe that's happened yet. Can validate that, and then we would get the replies, and then that would be negotiated.
Okay, and to clarify, that RFP will include the fee for the credit card payment processing and the ACH payment processing. And those numbers, those fees have in the past been the same amount for residential and then commercial.
Yes. $395 for residential and $650 for commercial.
Okay.
Yes.
So then it's, I guess, circling back to this average cost per transaction at the bottom of the attachment, those values, the 418, 415, those are not $3.95. So I guess in that read-in, can we just clarify again, just to be clear, if that's not the ACH, what is it?
Yeah, absolutely.
Thank you. And at this point, I guess my final question, you just mentioned that the RFP, it appears, has not gone out yet. But do you anticipate that it's hard to speculate here, but for the payment processing fees, would they remain the same or would they be similar? The program that you're proposing is based off of a number that we don't have at this time.
So you're asking whether I believe when we do get the negotiated rate, would it be less than the $395 and $650? I believe it would be.
Okay. And if the rate is less, how does that impact the proposal for this program?
So we're proposing a reconciliation so that on an annual basis, actually let me just make sure I'm stating that correctly.
Yeah, I think we've proposed that any over/under will be collected through a reg asset liability and trued up in the next rate case. So if the proposal does come in lower, those funds will be returned to customers.
Okay. Thank you. I believe those are all my questions.
Thank you.
Thank you, Chairman.
Thank you, Attorney Sellers. Okay, so we're gonna stop here for the evening. Adding up cross estimates, I think it's likely that we're going to conclude tomorrow, and I'll knock on wood. So if I can just ask that the company have your remaining witness panels available. I think right now we've got 4 outstanding read-ins, those being 2, 3, 7, and 8. And then we have a number of late file supplements that have been requested. So before we close tomorrow, we will settle on a due date for the supplements and address any remaining read-ins. So I'll just advise the parties and interveners that if there are any closing administrative matters, then I'd ask that you be prepared to address them tomorrow, as I think we're going to conclude then.
We actually have 2 read-ins right now. We can provide read-ins 2 and 3.
Okay, very good.
Okay, I'll turn it over to Mr. Hurwitz to do so.
I realize I may have mixed up 2 and 3, but I have both. I don't recall which is which.
Okay.
Read in to the extra $170,000 in legal expenses that we removed in LFE 1 for English station legal costs are reflected on Schedule WPC 3.12 as general legal support. In LFE 61, those costs are reflected in the line labeled claims management, which is Excel row 17, one below the one we were reviewing with Ms. Bidra, Attorney Bidra. Read in 3, none of the loyalty gifts amounts reflected in the company's response to LFE 85 were to employees that support English Station environmental remediation.
Okay, so can I just clarify? I think the question was if any of them were to any of the 6 English station managers, but it sounds like the response that you just read in was even broader than that. It's the payments weren't to any one supporting English station
That's correct, in LFE 85.
in LFE 85. Okay. All right. I'm sorry, I don't have LFE 85 up. I just want to make sure I understood that. But did LFE 85, I thought this described what a loyalty payment was.
It provided the amounts incurred by the company in the historical test year.
Okay. All right. Thank you. All right. Anything before we adjourn for the night?
No, that's it.
All right, very good. Then thank all the witnesses and parties and interveners for participation today. We'll adjourn till tomorrow morning. As a reminder, we are scheduled to begin at 11 a.m. tomorrow. So we'll take a lunch break between 12:30 and 1 roughly. So we'll see everyone in the morning. Thank you.